Rated PG-13.
Welcome to Squawk on the Street. I'm Steve Leisman. The big Fed news of the morning, of course, is Fed Chair Powell in his testimony before Congress pushing back against the possibility of a July rate cut from two of his committee members. More on that in just a second. But first, we have new comments from Cleveland Fed President Beth Hammack adding to the chair's view that rates should remain on hold. She says she does not see economic weakening that would merit rate cuts. The risk to maintaining current policy, she says, appear to be low. Current policy is only modestly restrictive. In fact, she says it's close to neutral. And if both sides of the mandate come under pressure, that stagflationary concern some have, best choice, she says, is to hold policy steady. And in fact, she warns policy could remain on hold, quote, for quite some time before the Fed does some modest cuts. And she does see a disconnect between the optimism in markets, which we see this morning, and the cautiousness that she hears from businesses she talks to in her district. Two factors, weaker dollar and higher oil prices, could add to pressure on consumer prices. But she does concede it's possible tariffs could have a short-lived effect. On Powell, very quickly, he did say that the Fed is well positioned to learn more about the course of the economy before adjusting policy. And the Fed needs to prevent one-time price increases from becoming ongoing inflation, essentially repeating his views. We have, very quickly, I'll show you the July Fed funds futures did drop on Powell's comments, but they remain relatively high for September and December. We'll have gavel-to-gavel coverage from the Q&A of Chair Powell's testimony with a big question about how much pressure he gets from lawmakers to cut rates as the president has demanded. Squawk on the Street, coming right back.
Let's get to Jim and stop trading.
Get ready to see this. Today, Chewy, okay? 23.95 million shares, secondary, 41.95. It's at 42.76. Start seeing people cash out, okay? Now, this is a BC partner seeks to raise $1 billion in share sale, but we're going to start seeing real selling. And that's because stocks are up very, very big. And Core Wave can't yet. I mean, Circle, but these are all candidates because they're just up so much.
Yeah, still a top pick over at Morgan Stanley today. Chewy.
Look, I think Chewy's great. Morgan Stanley put out a good piece, but this is what we have to see. We have to really digest this huge amount of stock that's going to hit us.
How about tonight? What do you got?
Okay, air environment. I think a lot of people are worried about how much, have drones. Are they out of drones? Who's got the drones? The cost of drones. So we have them. And then I'm going more. MasterCard's got an analyst day. We got to keep going on this Visa MasterCard because I know a lot of our viewers think that these companies are really at risk. I actually think this is your chance to buy them.
Right.
They're always at risk, and they always win.
That's 2 days in a row with Fiserv on a
They got a
partnership.
deal with them. They always win because of all the reasons why Ryan said we trust them. We're safe. This other stuff, who the heck knows?
Hard to get that with cash.
Yeah. Oh my God, David, they keep calling me and telling me to go against, saying that Trump screwed up.
People
was a
believe
big
you when
win.
you do stuff like that.
I know, I got him.
Sarcasm is very hard
I got him
to transmit. That's what I found through 30 years of TV.
They
People get
don't
sarcasm.
call.
Jim, we'll see you tonight, Mad Money, 6 p.m. Eastern Time. When we come back, there's a look at the Hill. Fed chair in front of House Financial Services. We'll bring that to you live in a moment.
Good Tuesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber, live as always from Post 9 of the New York Stock Exchange. Stocks are rallying today. We've got an S&P up almost 0.75% after President Trump announces a ceasefire between Israel And Iran, best performing group right now is information technology and financials. Both rallying more than 1%. Communication services also strong. So is consumer discretionary. Energy is the loser, down 0.75% as crude oil continues to sell off, adding to recent losses. As for treasuries right now, had seen a bid earlier. That's reversed a little bit. Some selling with the yields a little bit firmer. 10-year yield 4.35 ahead of Fed Chair Jay Powell's testimony before House Financial Services Committee. The Fed chair taken to the Hill. We'll bring you live to Washington for that in just a moment as he responds to questions from members of the House Financial Services Committee. Plus, former Treasury Secretary Steven Mnuchin will be our guest to talk about President Trump's renewed feud with Fed Chair Powell after another insult-filled social media post very early in the morning, overnight really, by the president.
All right, first we got some consumer confidence data crossing. Rick Santelli has that for us. Rick.
Yes, David, these are June numbers from the Conference Board. Headline number expected to be very close to 100. A bit of a disappointment. 93. 93 would be the best, well, just since March, so not that long ago. But the real issue is in between then and now. We had some really weak reads that proved to be very much should have been a contrarian indicator because the market went much higher. If we look at present situation, 129.1, that would be the weakest going all the way back to SEP of 24. And if we look at expectations, it comes in at 69. 69 would be the best, well, just since April of this year. There's also other data out, David. Richmond Fed manufacturing side and service side. These are June numbers. -7 on the manufacturing side. That would be the best since March of this year, even though it's a negative number. We haven't had a positive number. Well, we had one this year, and that was in February when it was only +6. If we look at the service side of the equation, comes in at -16, which happens to be the best since March of this year as well. Lots of negative numbers on manufacturing and several real negative numbers with respect to the service side in March and April, but they do seem to be moving up slightly, at least from the perspective of Richmond. We see that interest rates on the long end are hovering near unchanged. We have some slight positives in price on the short end, meaning slightly lower yields. But all things considered, especially with some of the volatility that we've seen in other markets like energy and equities, the Treasury market, for the most part, pretty calm today. Sarah, back to you.
Okay, Rick Santelli, thank you very much. And we've got Fed Chair Powell on Capitol Hill today. You know, we have this interesting dynamic shaping up inside the Fed about when is the appropriate time to cut interest rates and how is the appropriate approach to look at tariffs and whether they're going to be inflationary. Fed Chair Powell about to give his opening statement. In it, we know what he'll say, but here's the money line as it relates to his stance right now on policy. Increases in tariffs this year, according to Chair Powell, are likely to push up prices and weigh on economic activity. He's worried about the tariffs. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. He is very much wait and see. It's a repetition of what he said last week at the Fed meeting, but it's important because it comes after two Fed governors who get a vote at every meeting and are among the powerful folks at the Fed, and I'm talking about Waller and Bowman, came out and added a little bit more urgency into the discussion on rate cuts. Waller said, I think we're in a position that we could cut as early as July. He said that on CNBC. Bowman in Prague yesterday said if inflation remains contained, I would support lowering rates in July. And we'll just throw in Austin Goolsbee, Chicago Fed president, who's also a voter. If the dirt is out of the air, I think we should proceed with cuts. He didn't use the word July. But David, it's an interesting setup that we don't often get where members of the committee are coming out. I don't want to, it's not a different tune than Jay Powell, but it's certainly a different time frame, seemingly. And one thing I'll be really looking for today in terms of the Q&A from Powell is, will he be asked about July? And will he say that that's premature, or will he just sort of hang on to the let's wait and see the data because he's still nervous that tariffs are inflationary?
Yeah. I've made this point a number of times. We collected, I think it was $22 billion in tariff revenues in May.
Yeah.
And so we're looking for those signs already. You've reported on this many times. They haven't shown up as much. Survey data different than the actual, I guess, right? Fair to say, at least in terms of inflation expectations to some extent, but we're kind of waiting. That said, you mentioned July 9th, we may see a ratcheting up again of tariffs. So that adds yet another question, I think, in terms of how you're thinking about some out months here.
Right. It's impossible for the Fed to game out whether we're going to see tariff rates go up or down. I think what those in July are saying is that so far, the data has shown that tariffs are not inflationary overall, and it's been benign. And so we have restrictive policy. Let's just get ahead of any downturn in the economy or rise in the unemployment rate.
What would be the reason
going.
that tariffs have not yet been inflationary? I know that if they were, it still would be one time in nature. Many people have made that point. Of course, it's not as though it's going to recur necessarily.
So let's
but
look through it.
what would be the reasons why they haven't, Sarah?
Well, one is that consumer demand is just not that strong right now. So companies can't just pass on price increases like they did post-COVID because they don't have that kind of pricing power. We've seen that across all the consumer staples, for instance. And the other is that they're eating it. You know, they're figuring out ways to, quote, mitigate it, where they're making, you know, some of their suppliers pay part of the tariffs, right, overseas, or they're absorbing it and finding other cost, you know, efforts or productivity efforts to deal with it, to try to preserve margins. That's what we heard from Home Depot, for instance. We're not going to pass it on to the consumer yet.
Right. Or their margin, or they're eating it a bit in terms of their margin, but we haven't seen any impact in the stock market in terms of expectations of margin erosion, I don't think, or at least not that much.
Not yet. But, and the other, you know, those that are worried about tariff inflation say, well, you know, they pre-bought a lot of cars and a lot of retail inventories, and so they can get through that without having to raise prices. All of that remains big question marks. As we await the question and answer portion here of the Fed chair testimony, let's bring in Steven Mnuchin, former Treasury Secretary during the first Trump administration, Liberty Strategic Capital founder and managing partner. It's great to have you, Mr. Secretary. You know, lately the president has been really brutal with the Fed chair, insulting him. It happened again overnight. And he even called you out and said, you know, so much for the advice that I got from Secretary Mnuchin appointing him. I wondered if you could respond to some of that.
Well, let me first say, I think, you know, the president's been very clear over a long period of time what he thinks should occur on interest rates. And on this part, I do agree with him completely. I do expect the Fed will lower rates. We're going to see target rates come down probably 75 to 100 basis points over the next year. And the market's already priced that in. So, you know, my expectation is that publicly Powell is saying wait and see. But you've seen this with some of the Fed chairs, and I think that's coordinated. You know, if there aren't any surprises, I expect we'll see close to 100 basis points lower in rates.
I don't know. Powell's very much wait and see, and he sounds a little nervous that the tariffs are still going to be inflationary. I imagine, you know, after a lot of transitory being wrong, he's going to be extra cautious when it comes to lowering rates this time and making sure that inflation doesn't pop back up.
Well, my expectation is you're going to see the president announce a few trade deals. I know many of them have been in the works. I'm hopeful that if they're close and they haven't negotiated, you'll see an extension on the July date. And as we've seen, we've collected significant tariff revenue without it having an impact on inflation. And I think the market's expectation, and this is priced in, lower rates. So my expectation is we'll get there, and it's just a question of how quickly it phases in over the next year.
Do you think that Powell is indeed too late, as the president has nicknamed him?
Well, it's kind of irrelevant what the Fed has done, you know, historically. I think what's relevant is where the Fed goes from here. And I think the market has priced in. So the good news is the market isn't waiting for the Fed to act. You know, the market has taken this into account. And obviously, we've seen, look, an incredible week in terms of foreign policy and the president's leadership. I was very involved in, you know, all the issues and sanctions around Iran in the first administration. And, you know, really an incredible situation we've seen with the destruction of Iran's nuclear program, which was always an enormous concern of all of ours.
It is true. And you're hopeful that July 9th, David raised July 9th as a risk. Do you think we'll see higher tariff rates than we have right now as that deadline passes? If we don't have, I mean, even if we get some trade deals, there were a lot of reciprocal tariffs, very high rates on a number of countries.
Well, my hope is that, you know, these reciprocal rates were designed to get people to the negotiation table. This is really an extension of a lot of the work we started in the first term in making sure that we do have fair and reciprocal trade. The China deal took a long time. It's good to see that there's a partial understanding on China, but there's still a lot of work left to do with China and others. I'm hopeful that India and Japan and others will get over the finish line. And if they don't, the president will give more time to negotiate as long as there's progress being made.
When you say finish line, Mr. Secretary, what is a finish line? How loose can the framework be? What constitutes an interim deal at this point?
Well, I think the expectation is that you have something that looks like a letter of intent or a letter of understanding. Obviously, you can't design full trade agreements in this period of time, but you can agree on all the major concepts, and you can agree on the tariff rate.
Speaking of China, Stephen, since we had a lot of conversations around TikTok with you some time back and your potential interest, I haven't been hearing much of anything. The president obviously extended it again 90 days in terms of the ban not taking effect. Anything there, or do you expect that if we do get to a trade agreement with China in some way that it will loosen up the opportunity for somebody to do something on TikTok?
Well, my expectation is that the president will reach an agreement on TikTok. And, I assume he's made a lot of progress, and that's the reason why he continues to extend it. And that there'll be something that meets the obligation. I think the chances are it's not an outright sale. The chances are that, there's some new investors that come in and have a controlling interest, and that there's some ongoing relationship with ByteDance. But those details still need to be negotiated out.
Would you still have interest, or you kind of moved on?
I think we're sitting on the sidelines. We're busy on other things, but we're rooting for a deal to get done.
Sarah mentions sort of the jawboning that the president's been giving the Fed chair. One discussion we've had several times last couple of weeks is whether or not getting the Fed to cut at the short end would result in relief at the long end. And I wonder how you're reading the vigilantes at the long end right now.
I think the long end already has, the Fed cuts priced in. So, as the Fed has indicated, target Fed fund rates of something like 3.5% next year. You've seen the 10-year come down pretty significantly. Obviously, what's gone on in the oil markets and what's gone on with Iran are all good for the markets. And the fact that the president has now negotiated a ceasefire is all very, very positive. So, my expectation is that the 10-year at 4.30 has a lot of this priced in. We could see the 10-year come down to 4 to 4.25.
Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. Level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that would depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you, Mr. Chairman. We'll now turn to member questions. I recognize myself for 5 minutes for questions. Over the past few weeks, our Democratic colleagues have suggested the following. After the initial release of the GDP report, the president is driving the economy into a recession. Chairman Powell, the latest FOMC statement described economic activity had to continue to expand at a solid pace, and you just reiterated that in your testimony this morning. In your view, is the term recession and the economy growing at a solid pace, are those synonymous with each other?
I would say no.
And you note that the labor market continues strong, the economy's at a standard pace, and you also referenced in your testimony that first quarter GDP initial react was also from front-end loading. The economy's at a standard pace, and you also referenced in your testimony that first quarter GDP. Also, I looked at the Atlanta Fed GDP Now model, which forecasts GDP growth for the second quarter of this year at nearly 4%, with core GDP forecast at 2%. Does that Atlanta model suggest a recession to you?
No, I would say it doesn't.
So in looking at your remarks about tariffs today and then the ones that you made during March and April, I was looking back at a Fed study that noted that up until March, tariffs have already been partially passed through in consumer prices, leading to a contribution of merely 0.1 percentage point increase in core PCE prices. And a Harvard study last week showed that prices have only modestly adjusted since the announcement of tariffs. Finally, the longer-term inflation expectations remain consistent with the 2% goal. Governor Waller laid out a pathway that allows for rate cuts provided that average effective tariff rates remain close to 10%, or I assume he means 10% or lower. The labor market remains solid. Prices continue to disinflate. So given that data I've outlined, I'm sure data that you're very familiar with, for the economy to avoid persistent inflation, do you concur with Governor Waller that there is a pathway for good news as it relates to the regulatory policies, the tax policies that I've discussed, in a world with lower tariff rates?
So first, I wouldn't comment on any other FOMC members' comments one way or the other, but I will say this. I think many paths are possible here, and certainly the one you mentioned is a possible one. We could see inflation come in not as strong as we expect, and if that were the case, that would tend to suggest cutting sooner. We could see the labor market weakening, and that would also suggest cutting sooner. On the other hand, if we see inflation coming in higher, or if the labor market were to remain strong, then we would probably be moving later. So I think a range of possible paths are possible, and certainly the one you mentioned is one of them.
In February of 2021, you told us in this committee that you would stay in your lane and not comment on President Biden's proposal for the American Rescue Plan or sharply increasing federal spending. And, you said it was an issue, but that you would stay in your lane and not comment on it. But here in this year, you have commented on this idea of tariffs being set by the executive branch. So are tariffs in your lane, but a huge fiscal spending by the Biden administration not in your lane? Explain to the committee why you chose to be silent in February of 21, but outspoken this spring.
Sure. So we haven't commented, and it would be inappropriate for us to comment on the policy of tariffs. We don't have a view. It's not our job, and we just wouldn't do that. And just as we wouldn't comment on the reconciliation package that you're working on right now. We're not commenting on tariffs. What our job is inflation, keeping inflation under control, and also keeping maximum employment. And when policies have what appear to be short and medium term implications, meaningful implications for that, then they kind of, not the policies themselves, but the inflation becomes our job.
Yeah. My view.
Wix gives you the freedom to tell your story with a professional website.
For that, I've introduced legislation to make the dual mandate the sole mandate, and we've talked about that before. But I was very curious about your thoughts on former president of the Cleveland Bank, Loretta Mester's quote that I read from last fall. She says, "I think that maximum employment is the maximum level of employment consistent with price stability." In other words, she elegantly ties that together, that price stability is what you can have more control over rather than all these other factors that enter the employment picture like legislative and executive branch. What's your thought about her quote?
I personally think that's a very reasonable way to think about it.
Thank you very much. I yield back. The gentleman from New York is recognized for 5 minutes.
Thank you, Mr. Chairman. Good morning, Mr. Chair, Chair Powell, and thank you for being here. Last week, the FOMC decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. While I was not surprised by the decision to hold rates steady, I was surprised by the committee's revised forecast since March, which represented a decrease of 0.3 percentage points for GDP, a similar increase for core PCE, and an uptick in the unemployment rate to 4.5%. Can you explain the incoming data that the committee has seen since March that caused it to make these adjustments?
Sure. So, first of all, these are individual. This is not a committee forecast. These are just individuals submitting their own personal, forecasts, and we don't bless those as a committee. But I think people are looking at the incoming data and having a range of different judgments. If you look at the range, if you look at the central tendency, you'll see that it covers quite a wide range. Those are the medians that you're talking about. I think so. Inflation is projected to have moved up because of what we've seen, particularly from tariffs. And I think if you look at other outside forecasters, you'll see very much the same thing.
And what data are you looking for?
Well, we look at the incoming data on. We look at our own forecast, and we ask ourselves what's likely to happen. Monetary policy has to be forward-looking. A forecast is a prediction of what's going to happen in the future.
Thank you. In its statement, the committee announced that it will continue to monitor the implications of incoming data and adjust the stand of monetary policy as appropriate. Some analysts predict 2 rate cuts by the end of the year are still on the table. Is this a fair and accurate assumption? And what incoming data will the committee need to see to consider these cuts?
So what will actually happen with rates is going to depend on the path of the economy, and that's highly uncertain. So I would just say what that means at this moment in time is that a significant majority of the committee, but also there's a pretty significant minority that doesn't agree, but a significant majority feels it will be appropriate to reduce rates later this year. And what that means is that each of those persons who wrote down a cut in rates later this year, they think that there's some state of the world where inflation doesn't prove to be as high, or the labor market weakens, or some combination of those two things, that it will turn out to be more likely than not appropriate to reduce policy rates, subject to great uncertainty. I mean, we will. The story has been evolving, and our thinking has been adapting, and that will continue.
Thank you. Chair Powell, although a ceasefire has been tentatively reached in the Middle East, the situation still has the potential to open global and energy markets, especially if the ceasefire is broken, while at this point Iran is seen as unlikely to close the Strait of Hormuz. That decision could change. How is the Fed assessing the current situation and incorporating those assessments as it considers future adjustment to economic projections and its stand on monetary policy?
So I think it's too early to know what any economic implications might be, and I would not want to speculate. Like everyone else, we are, of course, watching the situation.
Thank you. And Chair Powell, after reviewing the economic data following the meeting last week, it seems to me that the committee is indicating that we could be headed for a situation where inflation accelerates while unemployment rises and growth become more sluggish. In this scenario, this will put the Fed's dual mandate of maximum employment and price stability in tension with one another. In this scenario, how does the Fed balance these priorities in order to achieve both mandates?
So let me say that we're not facing that right now, and that isn't really our forecast that we will face such an issue in a serious way. But if that does happen, then what we do is we look at the 2 goals and we see which one of them is farther from its goal. 2 variables, is maximum employment or price stability farther from its goal, and we prefer the one that's farther than its goal. And then we also ask ourselves, how quickly will they return to goal? it's a very difficult situation for any central bank. And, I would say, again, we're not in that situation right now.
Thank you, Mr. Chairman. Yield back.
The gentleman's time has expired. The Vice Chairman of the full committee, Mr. Heisinger of Michigan, is recognized for 5 minutes.
Thank you, Chair Hill and Chair Powell. Good to see you again. I got a lot to cover, so we're going to try and keep this concise. But following up a bit on what Chair Hill had been talking about, you had said in January 29, 2025, quote, "We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy." I would add energy into that, by the way. "We need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. This is no different than any set of policy changes at the beginning of the administration." However, December 18 of 2024 at the FOMC press conference, you noted, and I'm paraphrasing, that some Federal Reserve officials began to incorporate preliminary conditional estimates of how fiscal policies might impact the economy into their forecasts. This seems inconsistent, and I sidebarred with the chair to say, okay, did I hear this correctly, his question and sort of your answer? What I heard is that there was a belief that the IRA would not be inflationary, but that tariffs could be. Therefore, suddenly you and others were commenting on tariffs. And for the institution, I know you try to be consensus driven. Why are there FOMC participants making fiscal policy assumptions into their forecasting when you yourself said that fiscal policies need to be articulated before the FOMC can make a plausible assessment into their implications, what those will be? And I think if there's different participants having different assumptions, that would render the SEP, Summary of Economic Projections, biased, meaningless, useless, less impactful, and when you're not comparing apples to apples. So wouldn't it make more sense for all the forecasters to make the same fiscal policy assumptions at the same time? Or if not, shouldn't each participant disclose what assumptions that they're using and building into that? So here's the question.
So that's a great question. That really, when the Summary of Economic Projections was originally designed and put into effect in this way, the way it works is that individuals are free to make whatever assumptions they want, and they do disclose them. They disclose them in their speeches and things like that. So there will be situations where some people incorporate something and others don't, and we try to be transparent about that. But that's kind of the way it works. When I say we don't take it into account, I'm really talking about policy and the committee as a whole, where we won't take things into account until we know.
And you believe that the participants disclose their assumptions when they're doing their forecasts?
Well, I think they do that in their speeches. Each people go out. You may have noticed there are a lot of speeches.
Well, I guess the opaqueness of the Fed has been something over the arc of my 15 years on this committee has been one that has been debated greatly, including auditing the Fed and a number of other things that have gone on. I've got here a brief moment. I do feel like I need to touch on interest rates. Not to be a shock, you asked how the family business was doing back in Michigan. Families involved in sand and gravel and aggregates and construction and things like that. It's been strong. We need more labor. We need a few other things on that, what's happening. But I mean, I think there's no recession. That's been established. There's no hyperinflation, or certainly not as what some had been projecting. Yet there seems to be higher than expected, or certainly desired interest rates for many of us. And I'm curious how high interest rates, they hurt Americans who are paying car loans, credit cards, mortgages. Just this morning, you had FHFA Director Pulte asking for lower interest rates, which would obviously impact home buyers as well. So what is it that's keeping, in your mind, the Fed from what many of us believe is the right thing to do, which is to lower some interest rates, and by the way, match what the Bank of Canada, Bank of England, the European Central Bank, the Swiss Central Bank, a number of emerging central banks. By the way, that's your own assessment on page 33 as where you're laying that out. Why aren't we doing what the rest of the world is doing? Is it because we're at full employment? Is it because of those tariffs concerns that you said weren't part of the analysis? Was it energy, groceries, durable goods? Why?
So you're right that if you just look in the rearview mirror and look at the existing data that we've seen, you can make a good argument that that would call for us to be at a neutral level, which would be, a couple of cuts or maybe more kind of thing. The reason we're not is the forecast by all professional forecasters that I know of on the outside and the Fed do expect a meaningful increase in inflation over the course of this year. When I said we weren't going to talk about tariffs and inflation, that was to say until we see what the policies are. And so now we know a lot more. It's 6 months since I said that. So anyway, I'd be happy to continue this with you.
Thank you.
Gentleman's time has expired. Gentleman from Michigan, Ms. Tlaib is recognized for 5 minutes.
Thank you so much, Mr. Chairman. Chair Powell, last month there was research published in the Journal of Urban Health that found that more than half of Black women of reproductive age, that's the term they use, in the counties that I represent, that had experienced some sort of eviction during their lifetime. So that's like 50% of Black women in the two largest counties, Wayne County and Oakland County in Michigan. And these numbers are horrific. As you know, were you aware of that?
No, I was not.
And evictions are often very traumatic experience, but also it creates a cycle of poverty, but also this instability for many families. But especially when it comes to a lot of our Black neighbors, the access to equity, the access to housing is diminished even more. In Michigan, we lost more Black home ownership than any other state in the country during the last recession. So we know the housing crisis, I believe, is structural, and some may say it's a policy choice. While there are many factors at play, and you know this, Chairman, high mortgage rates, the finance rates and so forth, that drag the supply of new housing. But last month, new housing hit a 5-year low. Are you familiar with that?
I'm not sure exactly what statistic you are referring to.
Okay, I don't know. There was all this articles about the housing market and the impact of tariffs and so forth, and they said, again, it hit a 5-year low. And again, I'm getting this from a source. But this sets the market up for higher inflation and more burdensome housing costs to years to come. So Chairman Powell, I'm looking at this monetary whatever policy framework that you guys have put together. Do you think that the way it's structured, and again, I'm trying to understand how you're looking at this in the housing crisis, do you believe it's eroding new rental supply under construction right now, leading to high inflation in future years?
So I think there are two things going on quickly. One is just there's a longer run shortage of housing in the United States, which there's nothing that the Fed can do about. That's not something we can affect.
Well,
there's also, if I may say, in the short run, rates are high, and that's going to weigh on housing activity. But the best thing we can do for the housing market, the absolute best thing, is to restore price stability so that rates come down and so that rates can be at a level that people can afford.
But don't you think that the restrictive monetary policy the framework you all put together undermines long-term price stability right now by reducing the supply?
No, I mean, I think it restores price stability. The point of higher raits is to...
So you don't think the higher rates is impacting future supply of housing?
So I think what that does is, I think interest-sensitive sectors like housing are very much directly affected when we cut rates or when we raise rates. That's right. But that's part of the mechanism for restoring general price stability.
So keeping the high interest rates does not impact future supply of housing?
It does not, over the long...
I need to go back to talk to
over the long
women
run,
that the study...
Fed will not be, our policy will not be a driver of longer run housing supply in the United States.
Okay, let me ask you, what is the difference? And I'm honestly confused. I want to learn here, and I'm sure people listening to this want to learn. What is the difference between demand-driven rent inflation and supply-driven rent inflation? Like, you guys use these terminology. What is that? How do I communicate that to the public? What is the difference between supply-driven versus demand-driven rent?
Those are not terms that we use particularly often.
What's supply-driven formula?
That would mean that there's not enough supply to meet demand, but at the same time, it also means there's more demand than there is supply.
So are you guys ignoring that?
No, but as I said again, our policies will not affect in the long run. No,
I'm being serious,
demand
I
or
see somebody
supply
behind you
in
kind of
housing.
I'm being serious, y'all. We're talking about a housing crisis that is getting worse right now because we're not paying attention to future instability that the current rates, and you can raise your eyebrows and all this stuff behind. I don't know. I mean, do you understand? Like, I come from a community right now that I believe is now being impacted by the current framework that you're putting together, that I do feel like it's going to be long-term effects on the housing crisis, and you're ignoring it.
No, we're not. Actually, we think the very best thing we can do is to fully restore price stability at the aggregate level. That will be the best thing for homeowners and for home builders and everybody else. That's in the long run, that is the single thing that Congress has assigned us to do.
But you see where I'm coming from. It is impacting future supply of housing, right?
Not in the long run, no.
Okay. Well,
Gentlewoman's
Mr.
time
Chair,
has
thank you.
expired. The gentleman from Wisconsin, Mr. Stile, who's also the chair of our subcommittee on digital assets, financial technology, and artificial intelligence. You're recognized for 5 minutes.
Thank you, Chairman Hill. Thank you, Chairman Powell, for being with us today. I want to dive into two actions the Fed's recently taken to get a little additional color on. Yesterday, the Fed announced that reputational risk would no longer be a component in bank exams. I viewed that positively. I viewed the reputational risk as often being a catch-all for political bias. I think it's positive to depoliticize bank exams and instead focus on the core and measurable risks. Could you provide color as to whether or not any new or new information came to light that led to the decision of the Fed to remove that yesterday?
I'm not aware of any new information. No, we just think it's the right thing to do, and of course made an announcement on Monday under Governor Bowman's, Vice Chair Bowman's leadership.
Why would it not have been done previously if it's the right thing to do? I agree with you, it's the right thing to do. Why was it? Any timeline as to why that was done yesterday versus previously?
No, I think this is a problem that we came to understand as a problem over the course of the last couple of years, and began considering what's going on here. We're hearing a lot of reports of debanking and that sort of thing. And over the course of really 2024, came to the view that this was a serious problem that we need to address. And we've said that publicly. And now we're doing this, and so are the other agencies, by the way.
I appreciate you taking that action. I do agree that there were real political bias in some of those exams, in particular as it related to regulated entities engaged in the digital asset space. Let me shift into the digital asset space. If I can, another action recently taken by the Fed, the Novel Activities Supervision Program was ended and withdrew several statements on digital asset related risks that deterred bank involvement in particular. You in the Fed and others at the Fed have spoken positively about the House and Senate work to regulate stablecoin in particular, a real opportunity to dollarize the globe and be a significant purchaser of U.S. Treasuries. Following that action, by the Fed, have you seen an identifiable shift in banks or other regulated entities as it relates to engagement in the digital asset space?
You know, I wouldn't be the one to be picking that up first, but what I do see is a very significant change in the tone, and it really does reflect evolving thinking and the evolving status of the crypto industry. And I would expect over time we'll see more activity.
How is the Fed evaluating and overseeing banks or other regulated entities that are in the digital assets or crypto space?
So our view is that banks get to decide who their customers are. That's not our decision. And so banks are free to provide banking services to the crypto industry, to crypto companies. And banks are also free to conduct crypto activities as long as they do so in a way that is protective of safety and soundness.
Thank you very much. Let me shift gears because I want to give you just a little bit of an opportunity to comment on the housing sector once again, but give you a little freedom here to speak to that area. You correctly are trying to balance inflation and price stability, but also higher rates have a significant impact on the housing market as shelter and housing costs are a significant driver of why many families can't afford the things that they need. Can you provide color as to how you're analyzing the impact that housing and shelter costs have on families and on inflation with your desire to maintain price stability at the interest rates that is currently set by the Fed?
Sure. So, we realize that people are feeling high housing costs and high financing costs. In terms of inflation, we look at something called owner's equivalent rent and rentals, and that's meant to capture both rented housing and owned housing. And it's been very sticky. It's been one of the stickiest parts of inflation. I'm happy to say now it actually is coming down quite regularly. That's very good news. That's been the part, really it's been the service inflation that's been stickier than other parts of inflation. So that's good news for people, I think, and it is showing through into measured inflation now. Again, in the long run, the best thing we can do is restore price stability and let the market work. Even then, though, we're still going to have a housing shortage.
What data do you think is leading to the reduction in the rent equivalent?
I just think it took time. So the thought is when you would think that if rents come up every year, you would think it would take 1 year or 2 years for a lack of growth in rents to show up in a lack of growth in housing prices. It turns out it takes 4 years or 3 years. If you're an existing tenant, it's a complicated thought, but if you're an existing tenant, you don't actually catch up the way you would if new tenants came in. And so that's made the measurement of inflation stickier. But I'm happy to say we've been through that period now, and we are really seeing now housing services inflation pretty close to where it was when inflation was solidly at 2%.
Thank you. I yield back.
Gentleman yields back. Gentleman from California, Mr. Liccardo, is recognized for 5 minutes.
Thank you, Mr. Chair. Mr. Chairman, thank you for your testimony today. I appreciate that your dual mandate is full employment and price stability, and I appreciate your efforts on behalf of our country to achieve those. My understanding is that critical data is collected by the Bureau of Labor Statistics to help formulate the indicators that you rely on, that we rely on to understand unemployment rates, CPI, and other inflation indicators. We are certainly hearing a lot about the impacts of DOGE on our workforce, and specifically about the elimination of many of those positions in BLS. And now we have a proposal in front of Congress to cut $56 million from that agency. Are you concerned about the ability of your team to get accurate data and about the ability to have reliable indicators to make good decisions upon?
I wouldn't say that I'm concerned about the data today, although clearly there has been a very mild degradation of the scope of the surveys and things like that. But I would say the direction of travel is something I'm concerned about, and that is measuring the U.S. economy carefully and well is a project that's been going on, and we're getting better at it for 100 years and more. And it's really important, not just for the Fed, but for Congress and for businesses, frankly, to know what really is going on in the economy. What's happening? Is growth high? Is it low? And all those sorts of things. So I think it's a smart investment to just continually try to get better at measurement of what's happening in the economy. And I don't like to see that, the kind of stories I'm reading and the idea being that the data is going to become more volatile and less reliable. That'll make it more difficult for the private sector and for you and for us, and I don't like to see that direction.
I agree. Thank you. I appreciate that it's not your role to comment on the advisability of specific policies, but given your I have had conversations with, quite recently, just a week ago, with a C-suite executive of a major global retailer who informed me, because I asked, why aren't we seeing the impact of these tariffs and price data yet? And he said, it's coming in the third quarter, because it takes time for tariffs to work their way through a distribution chain. Often what you have on the shelf today may have been imported 2 or 3 months ago. Is that your understanding? Do you anticipate there may be impacts down the road?
Yeah, that's very much what I hear. I happened to meet with an unusually large number of business people in this last FOMC cycle, and that's a typical thing that they'll say, especially the retailers, that what's being sold now was in inventory in February, let's say, and it just isn't showing up yet. So we do expect to show up, tariff inflation to show up more, but I want to be honest, we really don't know how much of that's going to be passed through to the consumers. We just don't know, and we won't know until we see it. It could be lower than we expect. It could be higher. We have to wait and see, which is kind of what we're doing.
I appreciate the uncertainty. Another thing he told me that had me very concerned was that often they will increase prices on goods not subjected to tariffs to compensate for the very substantial losses that they have to suffer with the increase of tariffs on relatively price elastic goods. So in other words, necessities will also tend to bear a higher price, even if they're not subjected to tariffs. Is that your understanding of the potential impacts?
You know, that very much is something that companies will tell you that they do. If they can't cover the losses on the thing that's being tariffed, they'll find other ways to do it. We actually don't have prominent examples of that yet, but that's certainly a possibility. And that did happen in the last tariff episode with washing machines and dryers.
Thank you, Mr. Chairman. And finally, you know, there's indications in the introduction of the report that the Fed is losing its ability as we see interest rates getting closer and closer to the minimum threshold, the ability to stimulate this economy in times of recession. We haven't had a recession, or at least we haven't had an extended recession in a decade and a half. I am particularly concerned now as we are looking at debt that is being considered to be imposed on future generations by this particular bill. Could there be a combination of very high debt and very little room to move in monetary policy that could undermine our ability to respond to the next recession?
So we faced that issue quite a bit in the era of very low interest rates. But, you know, we're at higher levels of interest rates now, so there's significantly more room to cut than there was then.
Thank you.
Gentleman yields back. Gentleman from Wisconsin, Mr. Fitzgerald, you're recognized for 5 minutes.
Thank you, Chairman. Chairman Powell, thanks for being here today. Appreciate it. I want to go back to something we had some brief discussions about this in the past, but in September of 2024, with core inflation still being above target and the labor market was holding steady at the time, the Fed made a decision to cut rates by a full 0.5 percentage point. It kind of raised some serious questions as to whether or not the data truly supported such a move at that time, and I think some of us were surprised that it was a full 0.5%. So can you revisit that again, what the Fed was thinking at that time? Because it seems to be somewhat of an enigma now. It stands out as, you know, why was this done? Why was the 0.5% done at that point?
I'd be glad to. So, first of all, the inflation and employment readings were very similar then to what they are now. They weren't terribly different, a tenth or two.
Right.
But the difference then was you mentioned that the labor market was stable. It wasn't. The unemployment rate had actually gone up almost a full percentage point. I was very clear about this. We were very clear about it in real time too. The concern at that time was that there really hasn't been an experience, or hadn't been an experience in the modern era in which the unemployment rate has gone up close to 1% that hasn't been followed by much higher levels of unemployment and a recession. So we were looking at that and saying, and remember, at the point we're talking about, the federal funds rate was 5.3%, so definitely very restrictive level. We were the last of the big central banks to cut. So we wanted to make a statement that we were supportive of the labor market and not just inflation. We've been focusing on inflation. I was quite clear about this. So that it was all about the labor market. Inflation was the same and unemployment was roughly the same, but it was the rate of change with the unemployment rate that raised a lot of concerns. And remember, we were being criticized for being late to cut. So we could have done 25. If we'd done 25 in July, we were criticized for not cutting in July. Instead, we cut 50 in September. And it seemed like the right thing to do. You know, and at the end of the day, we do what we think is the right thing when we think it's the right thing to do. We don't take into consideration political factors. If we start doing that, I don't know where that stops. Once you start considering elections and stuff like that, where does it stop? You know, so
and I didn't want to insinuate that it had anything to do with the election itself, but there just seems to be some very similar numbers right now. And I'm wondering, and I don't bring this up because I want to kind of make a point about did the Fed do the right thing or not. I bring it up because it seems like everything's in place right now to kind of do the same thing, make the same move. I know this morning already, you've talked a little bit about where you were on inflation right now and kind of what you're watching, but is there any lesson there? I mean, are we in a position where it would be appropriate to do something as big as a 0.5% cut again?
Well, look, as I said earlier, if you just look at the basic data and don't look at the forecast, you would say that we would have continued cutting. The difference, of course, is at this time, all forecasters are expecting pretty soon that some significant inflation will show up from tariffs. Now, and you know, we can't just ignore that, but we're just saying let's wait and see more. That's all we're doing. And if you will have noticed, a substantial majority of the committee has written down rate cuts in the remaining 4 meetings this year. So it's just a question of being prudent and careful. But at a time when the labor market is still strong, we don't see weakness in the labor market. If we did, that would change things. You know, we're going to continue to adapt as the data adapt. But that is the difference between then and now. Then inflation was forecasted to continue to come down. Here it's forecasted to go up by all forecasters. So, and again, we're not overreacting to that. We're just saying, hey, as long as the economy's strong, we can take a little bit of a pause here. And that's what we're doing. And again, continue to adapt as the data comes in. If we see data that suggests that inflation's not going to produce big increases, you know, that would matter. And if we saw the labor market weakening, that would matter too. But we don't see those things.
What about supply chain? In 2020, that was a big issue, obviously related to COVID. But I know myself and other members, when we're in our districts and we're specifically talking to light manufacturing, there's concerns about the supply chain. Is that part of the data package that you review when you make a decision about where we're headed in the future?
Very much so. You know, I think that's one of the great, well, I won't call it a great thing, but one of the lessons to be taken from the last episode is supply chains really matter. We're watching that carefully. It's too soon to say really on that. We're not seeing it yet, but we could.
Gentleman's time has expired.
Thank you, Chairman. Yield back.
Thank you, Mr. Fitzgerald. The gentleman from New Jersey, Mr. Gottheimer, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, as a member of the Intelligence Committee, I'm deeply concerned about the threat of Iranian cyber attacks on our financial system as retaliation for our strikes on their nuclear facilities. In its cybersecurity report last year, the Fed acknowledged that critical infrastructure, including financial services, is at risk with rising geopolitical tensions. Iran has a history of targeting American infrastructure companies and financial institutions and banks, which could obviously threaten and cause economic damage. What actions is the Fed taking now to monitor and defend against Iranian or proxy cyber threats targeting our country's financial institutions?
So we're in touch with the other regulators and the parts of the government that work on cyber, as you know, and you know, we're in touch with the banks to say, you know, for people to be on the alert for things like that to happen, and also we're on the alert because you know we're a target as well. So you're right to raise it. It's a it's a big issue, and
do you feel like you have the resources right now to be prepared for that?
Yes, I mean I think we do. We spend a lot, and the government generally spends a lot on these things, and but you know, you can never ever be comfortable in this area because you know the bad guys are always getting better, so we need to get better.
Thank you, Chairman. Switching gears, the president and members of his administration have recently called you out, various name calling for certain decisions you've made. I know that some people worry that the president's bullying will impact your decision making. I know you work together, and I know that and respect, obviously, your independence greatly. Anything you want to add and give you a chance to reiterate your independence to the American people?
Yeah, I would just say we're focused on one thing, and that is we want to deliver a good economy for the benefit of the American people. That's it. And anything else is kind of a distraction. I don't mean to refer to any particular thing, but we stay focused on that task all the time. We always do what we think is the right thing to do. And, you know, we live with the consequences. And I don't know how else to do the job.
Right, so the name calling and the Mr. Too Late and all that stuff, the American people shouldn't worry about that. You're focused on being independent.
That's what I care about. I care about doing the job for the American people. The things we do matter a lot for people's lives, and that really concentrates the mind. You know, you want to just stay focused on that task. As long as you're sitting in these chairs that we occupy, focus on that task, do what you think is the right thing, and take the consequences.
Thank you, Mr. Chairman. You've previously stated that you view stablecoins as a form of money. Payment stablecoins are already being used for both retail and wholesale payments, as well as for settlement. Recently, this committee passed the Stablecoin Act and the Senate passed the Genius Act, both aiming to establish clear regulatory frameworks for fully reserved dollar-backed payment stablecoins. Given their design to maintain a stable value and be redeemable for U.S. dollars, should the SEC or other regulators explore treating these stablecoins as cash equivalents for accounting or financial reporting purposes?
So let me say, I think it's a great thing that bills are moving. We need a stablecoin framework on that particular issue. I don't have a view for you. I can come back to you on that.
I'd be grateful. Thank you. High rates have also caused, as we've discussed, the cost of paying off our nation's debt to skyrocket. The CBO estimates that interest payments will cost the U.S. $1 trillion in fiscal year 2026 and continue to rise to almost $1.8 trillion by FY 2035. How do you see us continuing to be able to afford to pay off our debt at this rate? And as the U.S. continues to borrow, how does that impact your decision to keep or cut rates? Obviously, foreign countries like Japan, who are significant buyers of our bonds, have started decreasing their purchases significantly. Other internal pressures worldwide are having that impact. Are you worried about this global issue?
Fiscal policy and it really is not our job, and it's not something we take into consideration in making monetary policy. That's really elected people's jobs. And I would add that, for some time now, the U.S. federal fiscal policy has been on an unsustainable path, and I'll limit myself to that.
Last question. Last week, you chose to keep rates steady, and families in our state, as you'll hear from a lot of people today, are really struggling with the higher cost of borrowing and putting off bigger purchases on things like cars and homes. As a result, their wallets being crushed by these price hikes and obviously the president's tariffs. What do you have to say to Jersey families who are struggling with higher costs, and how you look at how they should forecast themselves for their own families?
We're committed to returning inflation sustainably to 2% and keeping it there in the long run. And what we're doing now is we had cut rates by 100 basis points, so they've come down quite a bit. And when the time is right, I expect that will continue, and that will depend on economic factors, in the coming months for starters.
Thank you. I yield back. Thank you, sir.
Gentleman yields back. Gentleman from Nebraska, the chair of our Housing and Insurance Subcommittee, Mr. Flood, you're recognized 4 or 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, later this week, the banking agencies will be proposing changes to the supplementary leverage ratio, which we think are long overdue, considering the Fed in 2021 indicated that they would soon put out proposals for reform to the SLR and never actually did. However, our understanding is that the proposal being considered this week will not allow for treasuries to be excluded from the SLR calculation. Secretary Bessent earlier this year had argued that such a change could serve as a boost for banks and their ability to intermediate in the treasury market and could potentially pull treasury yields down 30 to 70 basis points. Chairman Powell, do you agree with the Treasury Secretary's comments on the potential positive impact of SLR reform on the treasury market? And what is the rationale for not excluding treasuries from the SLR calculation in the proposed rule?
So I agree that when the leverage ratio is binding, it discourages banks from undertaking low margin, fairly safe activities such as mediation in the treasury markets. So this should encourage more mediation. I don't have a numerical estimate of how much that would matter, but I do think it would matter. I think it was important. I've supported leverage ratio reform for a very long time, since before 2000.
Potential, because that's how we get our economy firing on all cylinders and work to continue to close the racial wealth gap, which my home city of Atlanta continues to lead the nation in. That seems like such a far cry from where we are today, almost a year later. Forget our economy firing on all cylinders. Now our economy and our nation seem to just be on fire. We're looking at tariffs that are raising the prices of groceries, fuel, housing, and everyday goods. Chairman Powell, I get feedback every time I'm in a hearing about my nails because I like to get my nails done. And my nail tech told me about the increase in cost of so many of the different products that would be used just for me to get my manicure monthly, because tariffs are frightening so many of our small businesses, which we know are the backbone of our economy. And so it's hurting my community in Atlanta. But it doesn't seem like our president and my Republican colleagues are really interested in making sure that our economy fires on all on all cylinders, as long as billionaires continue to get richer, because that's what we've seen and all of the gutting that has been done to the federal government. And Chairman Powell, I'm sure that this is coming to your department as well. With the recent events that we've seen, we know that it is very dangerous to gut the federal government, agencies that we depend on, and politicizing the work of agencies such as yours. Chairman Powell, this current president has tried to reclassify tens of thousands of non-political public servants just to make it easier to fire them. And that includes people who have served in Democratic and Republican administrations. It even includes people who serve in independent agencies just like yours. Chair Powell, as a chair who our current and previous president routinely has threatened to fire, I think I just heard something on CNN today while you were here testifying. But what effect has this policy had on the career civil servants in your agency? And are these threats making it easier or harder for the Fed to do monetary policy?
They're having no effect. We're doing our jobs.
You're doing your jobs. I appreciate you doing your job, even when it might not be easy. It is important to tune out the things that you hear on the media, because I hear it every day representing a district that has a lot of federal employees, a lot of people who work at your agency. I hear from people all the time. Thank you so much. And not only do I have thousands of federal employees in my district, but my district has one of the widest racial wealth gaps in the country. Much of that has to do with our worsening housing crisis. And unfortunately, as we've seen with the past 6 months, this administration has been focused on this big billionaire bailout bill, gutting HUD, and releasing a budget that does not help the supply of fair and affordable housing nationwide. Now we've heard the president talk about having the power to control interest rates. In your opinion, Chairman Powell, what would you expect the effects would be on the housing market if the president were to lower interest rates without addressing the housing supply crisis nationwide?
Sorry, if he were to what?
If the president has talked about having the power to control interest rates. In your opinion, what would you expect the effects would be on the housing market if the president were to lower interest rates without addressing the housing supply crisis nationwide?
Honestly, it's not our job to speculate on things the president might do.
So what impact do interest rates have on housing access?
Over the long run, they don't really affect housing supply. You know, assuming that rates will go up and down.
Well, not on the supply, but on the housing market. The supply is separate that we need to address going into this. If we're going to move interest rates up and down, that's not going to be the end-all be-all to getting people into housing. We must address the housing supply crisis. But what impact do interest rates have on the housing market in general?
Well, interest rates really affect housing demand. So with lower rates, you see more demand, and higher rates, maybe less demand.
Thank you, Chairman Powell. I am out of time, but I have lots of questions that continue to work to close the racial wealth gap in this country, specifically focused on my district in Atlanta, where it is so prevalent. Thank you so much.
Gentlewoman's time has expired. The gentleman from Indiana, Mr. Stutzman, is recognized for 5 minutes.
Thank you, Mr. Chairman. And Chairman Powell, great to see you. And again, as I've mentioned to you before, always appreciate your steady hand at the wheel and not, I guess, getting out of your lane necessarily, but obviously you have a huge impact on the economy and what's happening there at the Fed. I want to kind of follow up a little bit on housing, as I've been hearing a lot about the housing concerns in Northeast Indiana, and I know you're not you're used to being beat up on a lot by folks all around the country, but I want to speak specifically to one particular individual, Cardone Capital, Grant Cardone. He made some pretty strong remarks about your policy when it comes to the housing industry, and he said, that's why you have 500,000 more homes listed than buyers for those homes. When the rates come down, prices will also come down with it because you'll have more supply in the marketplace, and supply is what controls prices. He went on to say that interest rates do not control prices, and he explained that lower rates could stimulate activity in the market, and activity is what makes the economy work. And I agree with his comments, overall, but I believe, as you said earlier, the economy seems stable, and I would agree with that coming from an ag and manufacturing area. It's not booming yet, but I believe most people are optimistic that the good times are coming and that the structure is set and in place. But when it comes to housing, It seems like that's where a lot of Americans are, they're stuck. You know, they've had low rates, they've got a good mortgage rate, but if they want to make a move, they have to go out of that 3% interest rate into, 4.5%, 5% or higher percent interest rate. Thoughts on addressing housing, because their prices are up for sure, but people aren't, there's no activity. The velocity is very slow. Would you like to comment on any of that?
Sure. We see the same thing you do in the housing market. It's tough. There's not people are locked in. They can't afford to get out of their house because the cost of getting to a higher mortgage, higher price mortgage would be a lot. So the best thing we can do, though, is to get inflation sustainably down to 2% and have it stay there over a long period of time. And that is really what we can offer to them. And I think, so if you go back to the beginning of the pandemic when we
Well, thank you, Mr. Chairman, and thank you, Chairman Powell, for joining us again here. We have a saying, Iowa is nice, kind of boring. We want our Fed chairman to be just the same, and you're doing a great job at that. We appreciate it.
Thank you.
Nothing against boring. We like that too. Look, you have a lot of great staff that come from Iowa as well. I appreciate you having them on your team. We also want to recognize the fact that, folks in Iowa are still feeling the challenges of the last 4 years. We're middle America. It is the heartland of the country, but it also means that impacts that change things on the coast don't always get felt the same way in the Midwest. And so as a result, folks are stretching every dollar as they face everything from higher grocery prices, eggs, to trying to buy just that first car or even maybe that first home. And interest rates to them matter as they do everywhere else, but they're even more. Now, I will offer the president has made great strides in making progress for Iowa families, and wage growth is moderating nationwide. Many Iowans still feel, though, that inflation spikes impact them. And with the president focused on rebuilding the middle class, I'd like to talk a little bit about how the Fed ensures that this heart of the heartland can feel the benefits of a soft landing as you've laid out.
Oh, you're asking me how you will feel the benefits of the well, I would think pretty open-ended question. So I think our goal is to keep the economy strong, the labor market strong, and price stability fully restored. So that's really what we can provide is a long period of stable prices, and we define that as Chairman Greenspan used to, which is people can make economic decisions in their families and their jobs where they don't have to think about inflation all the time. And we're getting back closer to that place, but we're not quite there yet. That's the main thing we can now do. And once we restore price stability, very soundly, that gives us the ability to react more strongly to downturns in the economy without having to worry about inflation. And so that's we have limited scope, but those are two very, very important things that we can deliver that benefit all families.
I would agree. So I guess I would also like to focus here on the short term. The Fed Reserve has slightly lower rates to ease borrowing costs for rural communities, and long-term trade negotiations strengthen our global position. Would you agree that the agricultural sector in particular is vulnerable to both interest rates and recognize international markets? And how would the Fed evaluate the unintended consequences of policy on commodity-dependent economies in a state like Iowa?
So we have a number of our Federal Reserve Bank presidents represent districts which have extensive agricultural operations and families and farms. And so we hear from them kind of all the time, but we hear from them in great detail around every FOMC meeting. And we understand that times, pretty challenging right now in the agricultural sector. We take that into account. Ultimately, we're responsible for the aggregate level of the economy and for keeping inflation under control and maximum employment. So, but we do very much think about and take into consideration the agricultural sector and the people in it.
We appreciate that evaluation. I know there are farmers back home as well as, our bankers who value that because they're the one providing the capital for it. I want to talk a little bit on the national security side as the vice chair of NatSec here. If foreign actors begin weaponizing treasury sales or dollar reserves, what tools does the Fed have to help preserve financial stability and the dollar's status as a reserve currency within the world?
Essentially what makes us the reserve currency is a few things. It is our great democratic institutions. It is that we have open capital markets, very open capital markets, and it is that we have price stability and the rule of law. Those are the things that make you the reserve currency, and you can keep that status as long as you maintain those things. Of those things, the thing that we contribute is price stability over the long run. So people who want to invest in or use the dollar, they can be confident in the value of the dollar over time, that it won't fluctuate wildly or decline in ways that, and so that's our role. Really, Treasury is responsible for stewardship of the dollar, but we have that role to play as well.
Very good. In the brief time that I have left here, I just came back from a trip to Saudi and the Arab states. Big concern here in the world we're living in right now, with Iran looking at asymmetric ways to threaten the United States. Cyber attacks have been on the rise. You got a question here earlier on cybersecurity. Help us feel confident the Fed is doing everything they can to protect us from a cyber threat.
So our part of it is the financial sector and the institutions we regulate, and they spend a lot of time and money on cybersecurity. We spend a lot protecting ourselves, and there are other parts of the U.S. government that are very much involved in making us aware of cyber issues and making sure that we're all ready. And we never sleep on this because it's always getting harder.
Thank you, Mr. Chair. I yield my time.
Gentleman's time's expired. The gentleman from California, Mr. Vargas, who's also a ranking member and my colleague on the Monetary Policy Task Force, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman. Thank you, ranking member. Appreciate it. And of course, Mr. Powell, thank you very much, Chairman Powell, for being here. I'm 64 years old. You're a little bit older than I am. In my lifetime, I know what the most dramatic economic event is, at least that I believe. In your lifetime, what do you think is the most dramatic economic event that you lived through? As a country, as a world?
So as an adult, I would say the global financial crisis and the pandemic.
No, just one. You get to pick one.
Big events. Sorry?
You get to pick one. You pick two, just one.
I would say there's a third, which would be the great inflation. So I'm going the wrong way here.
You're going the wrong way. Yeah, just pick one.
I'd say the global financial crisis was, in a lot of ways, scarier than the pandemic for me.
Yeah, it's interesting because both of them were ones that I lived through too. And I have to tell you, the most dramatic for me was the pandemic. In so many ways, I'd never seen anything like it, where everything closed down. I remember flying here from San Diego, where I live, on a 737, and there were 4 passengers. There were 4 of us on the plane. Of course, some idiot sits right next to me. I think, what are you doing? You stupid, move away. But anyway, it is interesting that we didn't fall into the recession. We didn't fall into a depression. I was really scared about what was going to happen because of the way we closed down. We didn't know it was going to go. We didn't know it was going to happen. And I think a big reason for that was the sort of the strength that we had at the Fed, and the country came together and said, we're going to figure this thing out. And we did that. You didn't panic. You guys were very independent. I think everyone did their job. The reason I say that is because I do worry about the independence of the Fed now going forward. So question, can the president appoint himself as the Fed chair?
It's a question, but not for me.
You're the Fed chair. You should know. You should know what the requirements are to be the Fed chair. Can he appoint himself?
I don't know.
You don't know that question? What is? Well, you're the Fed chair. What is the requirements to be the Fed chair?
Nominated by the president, confirmed by the Senate. I think you probably have to be a U.S. citizen, probably, but I'm not sure.
Okay, so far it seems like the president fits those. He's a U.S. citizen. He can propose himself, and I assume that the senators over there could confirm. Why couldn't he become the Fed chair also?
Again, not a question for me.
Okay.
I wouldn't speculate.
The reason I ask that is because, again, I do think that we have a great system because of the independence of the Fed. And it worries me that more and more, and I assume, I'm not going to ask you this embarrassing question, although I would like to, whether you read all the things that he says about you. I'm sure you do, or some people tell you. Yeah, but I won't tell you what they are. But I'm glad you've been independent. And I think that that's so important because you do look at long terms. It's not missed on you. You know that we want you all to lower the rates. You know that, both sides, right? You get that. The answer could be yes or no.
Honestly, I'm not sure I do know that. I talked to a
Well,
lot
I
of
can
members
tell you, from our
privately.
side, we'd love to see the rates go down. And I've heard from a number of my colleagues on the other side, we'd love to see the rates go down.
I talked to
I
a
think
lot of
they'd pretty
members who
unanimously
say
like to see it.
privately, you're doing the right thing. I hear that from a lot of members privately.
Yeah, oh,
But in any
good.
case, we have to do, we're appointed and confirmed, my colleagues and I, do what we think is right.
That's exactly right, and that's why I say it, because I think it's not lost on you that we all want the rates to go down. In fact, it's really real when you say, someone's locked in at 3% at their house, their interest rate, so they don't want to move and get a 7% rate. I mean, they don't want to pay that. That's real. My colleagues mentioned that, and that's truthful. And that's why it's so important to be independent. Now, lastly, I do want to ask, because again, it's so darn important to have an independent Fed chair and an independent Fed. Secondly, the dual mandate. I respect the chairman very much, and he's a friend. Hope that doesn't hurt him politically. But that being said, he did ask you a question about the dual mandate in a way that he quoted somebody else and said, is that the way you see it? I do want to see, how do you see the dual mandate? It seems to me that you gave a little bit of a preference to price stability over maximum employment. Is that the case?
No, I think the two things are equal under the law. But if the thought is, we haven't defined it in exactly the way that the chairman said, but notwithstanding that, I do think it's a reasonable way to define it, which is the maximum employment is the maximum level that's sustainable or consistent with price stability over the long run. That doesn't make it, to me, an inferior goal.
Gentleman's time has expired.
Thank you.
I think it's kind of
Mr. Chairman.
implicit in a way.
The chair now recognizes the gentlewoman from Michigan, Ms. McLean, for 5 minutes.
Thank you, and thank you so much for being here. I appreciate it. As a business owner, small business owner myself, access to capital is extremely important to me. So I want to talk a little bit about the Fed's balance sheet and just get a better understanding of how we're thinking about it. I mean, some experts say that the Fed's balance sheet or large balance sheet is distorting the markets and keeping long-term rates, let's say, too low. Also, I think it limits the access to capital, right? Historically, if I'm accurate, the balance sheet's been about $4 trillion prior to the pandemic. Then we raised it, almost doubled it to about $9 trillion, and now it's on a kind of a downward trajectory to about 7.2. Again, if my math is right. Do you think we're on the right track in shrinking this balance sheet?
I do, yes.
I'm trying to get a sense of what the landing spot, in your opinion, should be. Do you think we'll get back to the $4 trillion?
No. So we're in what we call an ample reserves regime. And what that means is that the quantity of reserves, demand fluctuates, and this means the quantity of reserves can fluctuate without affecting interest rates. And we think that's a good thing. What that means is there's going to be a lot of liquidity in the banks and in the financial system. That's a good thing. There wasn't enough liquidity before the global financial crisis. That was one of the problems. We have some shrinking left to do on the balance sheet, but we're not going to get down as far as you asked.
Where do you think we'll land? Because let me start. I'm sorry. Where do you think we'll land?
I can't give you an exact number, but we're going at a pretty modest pace now. We've slowed down, kind of cut in half twice the speed. We think we can go for a good while at this speed, and we'll learn as we go.
So you think the trajectory, so to speak, will remain?
Yes, and I think the fact that it's quite a gradual trajectory now is going to enable us to find that level that is ample and not scarce. When reserves are scarce, you get a lot of volatility, and that doesn't help. So I think that's a good framework. The ample reserves framework, I think, serves the country well.
And you're not concerned in terms of the access to capital? I mean, as a business owner, that's what I look at is I got to be able to get capital, and some people are saying, we're really hanging on to our cash.
I think honestly, I think if you took the trouble to go back to a much smaller balance sheet, it would have no effect whatsoever on capitalability for companies. You wouldn't do that at all. We're not pulling capital away from companies. That's not what's happening. It's just you have a big balance sheet where there's a lot of liquidity. The result is there's a lot of liquidity. Banks are flush with liquidity for the most part, and that actually enables lending. It probably wouldn't have much of an effect one way or the other if
So
you
you're
went back to a
comfortable-
smaller balance sheet.
So you're comfortable with the liquidity, you're comfortable with the access to capital, excuse me?
I mean, we look at credit availability for smaller businesses, and, right now, conditions are a little bit tight.
Yeah, it's
but-
tough for people in my district.
Yeah.
It's
I would say that they're not
it's tough.
terribly tight, but we do see that there's some tightness, but that's not really a function of the Fed's size of the Fed's balance sheet. That's just that banks are perhaps a little risk averse in this uncertain environment.
I think it all goes together and is kind of intertwined, but I appreciate that. I want to just switch gears a little bit. Are you seeing any signs of financial instability building beneath the surface that we may not be seeing maybe on top of the surface, whether it's in commercial real estate, private credit, regional banking, anything you're seeing underneath the surface that could derail the growth path?
Not really, no. I mean, you mentioned, there are a lot of pots that we need to watch to see that they don't boil over. CRE, has been a problem for 5 years. We're working our way through it. I think we're making good progress there. It's not getting worse, it's getting a little better. Private credit is, has its real positive attributes. It's not funded by deposits, so it's not, as long as it's not funded by retail or by deposits, it's actually fine for financial stability, but it's a very big and fast-growing sector, and it hasn't been through a real downturn, and it's quite diverse, so I think it bears close watching. I mean, asset prices are high, but leverage is not particularly high for corporations and households historically. It's not particularly high for banks. Banks are well capitalized, so I think overall financial stability conditions are not in a place where we worry a lot.
So we're really poised in a pretty good position economically.
Gentlelady's
I
time
think
has
so, yes.
expired.
Absolutely.
Thank you, Mr. Chair. Thank you.
The chair now recognizes the gentleman from Illinois, Mr. Caston, for 5 minutes.
Thank you, Mr. Chairman, and Chair Powell, nice to see you again. We had spoken in February about some concerns I had about some of the cuts in some of our economic data reporting agencies, and I think you'd said at the time that you didn't have a concern, but if you would alert us if there were concerns. You'd mentioned this with Mr. Liccardo, and I gather, if I'm paraphrasing you, I think you said that you're not concerned about your access to data right now, but I think you said that you don't like the direction of travel. I wonder if you could speak to, well, first, I'm going to work under the assumption that as the chairman of the Fed, you probably have more access to economic data than just about anyone in our country. I am more worried about the impact on smaller businesses that don't have your access to data, whether, someone thinking about hiring decisions, looking at regional inflation rates, all the data we get from those resources. How concerned should we be, if an efficient economy depends on, at some level, on equal access to information? How concerned should we be that our business community, with some of these cuts to BLS and elsewhere, is not going to be able to allocate capital as efficiently as otherwise would be in this moment?
The reality is that essentially all the data we use overwhelmingly is public data. The difference isn't that we have more access. The difference is that this is our job, and we follow the data very, very closely. But, the employment reports, the CPI reports, the analysis of that by many economists, internal and external. We just spend all of our time on this stuff. But I think large businesses have the exact same.
Well, but I'm talking about
businesses,
BLS has announced they're cutting 350 indexes, so that data is no longer going to be public data.
That's a different thing. Okay, so if you're asking about that, I don't want to say, and it wouldn't be true to say that we can't do our jobs with the data that we have now. That's just not true. The data overall, we get the data. These jobs you're always going to make mistakes. It's never going to be certain in any time. But I would say seeing that survey sizes are shrinking and we're seeing more volatility, for example, in the labor market data, lower response rates and things like that, that's not good. We should be getting better and better and better. Yeah. I would add the private sector, by the way, we use more and more big private sector data sets. And that is a relatively new thing for the last 5 or 10 years.
Yeah, and oftentimes
it doesn't replace the U.S. government data has been the gold standard.
Yeah, and I guess I get concerned because some of those data sets, of course, you have to pay for, and not every business can afford that. I want to, staying on the data point and picking up on what Mr. Himes was saying, I think only a fool would predict they know what's going to happen in the Middle East right now. But I get concerned that we have trying to handicap The Saudis have been very open that they would like to not see the price of oil get above a point where they're going to lose market share, much to the dismay of U.S. frackers. U.S. frackers have been wanting to see it go the other direction. I don't know how to handicap which group is going to have more impact on Trump right now. But I would like to have some smart person out there taking a position on what is happening in oil markets. And the Energy Information Administration has now announced they're not going to run the International Energy Outlook anymore. Should we be concerned about that piece of data as we think about what's happening in global energy markets right now, given all the pressures between various suppliers of where they'd like to see the price go and the wild card that is Iran and the Red Sea?
You know, I don't particularly know that specific report. You know, I know there are many entities that do data analysis around energy and oil and the availability of it and the price of it and all those things. So I can't speak to that one report.
Okay, well, I mean, again, just my own experience before coming here, I relied a lot on that, and if I was in my past job, I would now basically have to rely on the International Energy Agency, which in general was Bernanke, both recently Office of Financial Resource that are in the bill that the Republicans are pushing through. Do you share your predecessor's concerns about the importance of that agency to synthesize some of this disparate things so that you can do your jobs, that the American people can do your job, or do you share the views of the Republican Party that that agency is not necessary?
You know, I'm not going to take a position on the bill, on the reconciliation package, on specific issues like that don't relate to us. I will say generally, I'm a big fan, and everyone at the Fed is a big fan of good data collection.
Gentleman's time has expired. The chair now recognizes the gentleman from Montana, Mr. Downing, for 5 minutes.
Thank you, Mr. Chair. Our national debt now exceeds $36 trillion. Congressional Republicans have made it our mission to rein in out-of-control spending, from repealing the Green New scam, enacting common sense Medicaid and SNAP reforms, and rescinding wasteful spending. Mr. Chairman, you have repeatedly said our national debt is not currently at an unsustainable level, but it is on an unsustainable path. Can you describe what the point of no return looks like when our debt reaches an unsustainable level?
So there's no way to know exactly what that is, but ultimately, if the debt is growing substantially faster than the economy, by definition, at some point it will not be sustainable. So, we don't have oversight responsibility over the fiscal authorities, but that's traditionally what my predecessors have limited themselves to saying, and I'll say it too.
And what effect would that have on the economy?
So you'd see rates go up. It would be very challenging to.
Welcome to Turo. What can I get you?
Yeah, hey, I've got a camping trip this weekend. Can I get a gray Bronco with all-wheel drive and a sunroof, please? Thanks.
The Trump administration is actively negotiating to ensure we are no longer taken advantage of by our trading partners. At a previous Monetary Policy Task Force hearing, all of the witnesses agreed that the recent volatility in the Treasury markets did not permanently damage the dollar's global reserve currency status. Do you agree?
I do.
Thank you, sir. Let me turn to oversight of the Federal Reserve. I certainly believe that had the Federal Reserve responded faster by raising interest rates earlier to combat the inflation crisis of the previous administration, that interest rates would not be as high as they are now. I hear frequently that from my constituents that they're increasingly getting priced out of the housing market while interest rates remain near record highs despite the rate of inflation coming down. So, Mr. Chairman, I appreciate the Fed's increased transparency under your leadership, and you've always welcomed congressional oversight into the Fed. And I also appreciate the comments you've made about the limits of our knowledge demanding humility. So with that in mind, can you point to oversight practices of other governments into their central banks that could be replicated with the Federal Reserve?
That's an interesting question, and I want to think about that. I'll come see you and we can talk about that. I think
sir.
we have effective oversight from this committee and from the other committee in the Senate, and I think that's important.
Would you be supportive of an outside independent group of analysts or economists that conducts a periodic review of the Fed's economic assessments and modeling?
So those are ideas I'd like to think about and discuss privately before.
So do you have any other ideas to increase oversight in the Federal Reserve?
I think, like my predecessors, I've fostered, more and more transparency at the margin, and I think that's appropriate. I think transparency is critical if we're to maintain our democratic legitimacy. So I've tried that, but I'll devote some more thought to that question.
Well, I look forward to following up, and I thank you for your responses. And on that, Mr. Chairman, I yield.
Gentleman yields back. The chair now recognizes the gentleman from Texas, Mr. Gonzalez, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being here with us today. I understand commenting on some policy issues are outside of your purview, but I have one that I think is heavily impactful on the American economy right now, and I want to underscore the scale and impact of the ICE raids that we're seeing across the country. Pew Research estimates that over 10.5 million undocumented individuals live in the United States, more than 3.3% of the population today. And according to the nonpartisan American Immigration Council, removing this workforce could cost the U.S. economy between 1.1 and 1.7 trillion in GDP and billions in tax contributions, including 22.6 billion in Social Security and 5.7 billion in Medicare funds that are increasingly critical as our population continues to age. These are resources that are paid by these undocumented workers that have been here for a long time. Many of them have been here for a very long time. That's why I plan to introduce the Save the American Workforce Act, which would establish an employee-sponsored temporary work authorization for undocumented immigrants who have been in the country for 3 years or longer and have never been in any kind of trouble, no criminal liability or nothing else. Additionally, last week I sent a letter to President Trump urging him to halt indiscriminate deportations and issue an executive order that would do exactly what my bill does to protect American businesses that need a workforce. We have the last I heard, I think we have 7 million open jobs. We have a record low unemployment, which is great, but we have 7 million open jobs that we cannot fill by American workers. What economic consequences would we face if these individuals were removed from the workforce, even further hurting the situation that we're in? Could this disrupt even more the economy even more severely than what we experienced during the Great Recession?
So, as you might expect, Mr. Gonzalez, immigration policy is just not for the Fed to comment on or to, let alone make, and so I'm reluctant to engage with you on that.
Okay. I want to talk to you something a little differently. We have, and this is a banking issue. Banks are making, billions of dollars of construction loans across the country that are timelined, and contractors are not able to fulfill their obligation because they don't have the labor force in the middle of the jobs to finish. I mean, I'm hearing stories in Texas, at least, where people are pouring concrete at midnight. Are y'all having any kind of conversation with the administration on how this could impact the economy and our GDP?
So we have very deep connections all over the country through the reserve banks, and we hear some of the same stories. But for us, we're not the policymakers here. We don't report this to the administration. We don't just publicly have a view on it. It just is what it is. So
yeah.
Our responsibility, maximum employment, price stability, many other factors affect those goals, but we don't make those goals. We don't make the policy in those extraneous areas, which include things like energy, for example, or immigration, or fiscal policy, or any number of things. We try to stick to our knitting because that's how we remain independent.
Yeah. We're living such unconventional times that I would love to have that. It would be great if y'all were having those conversations in the administration. But moving on, the U.S. dollar has also long been the world's dominant reserve currency, but that position is facing growing pressure. As of 2024, BRICS nations led by China and including Brazil, Russia, India, and South Africa have stepped up efforts to reduce their reliance on the dollar in global trade. China, for instance, has expanded the use of the yuan in energy transactions and cross-border payments, while BRICS is actively developing alternative payment systems that could erode the dollar's global role. At the same time, inconsistent and unpredictable economic policies from the White House have contributed to a drop in the dollar's value, now at its lowest level in 3 years. What risk does a weakening dollar pose to our economy, particularly to U.S. borrowing costs, inflation, financial stability, as China and BRIC nations expand their efforts to challenge the dollar's global dominance?
So, by long agreement and custom and tradition, the Treasury Department has responsibility for the dollar and dollar stewardship. I would say we also, are involved in payments policy, and, we're very aware, we and the other major economy central banks are very aware of other payment developments and, working on ideas to make sure that the payment systems that support the dollar and other, other major currencies of the democracies are well supported by that infrastructure.
Thank you. I yield back.
Gentleman's time has expired. The chair now recognizes the gentleman from Florida, Mr. Ardopoulos, for 5 minutes.
Thank you very much, Mr. Chairman, and thank you, Chairman Powell, for being here today and answering these questions for us. It's very much appreciated. Looking back over the last few years, I think the question a lot of people have been asking me as they really were suffering through the challenges with higher prices across the board. I know they got as high as over 9% inflation in 2022. And there's a lot of discussion about, was it Ukraine, was it transitory, was it post-COVID? What was the reason? As you look back now in those years, and this is your field of expertise, if you look back and you're teaching a history class, what would you blame the increase in prices on back at that time period?
So I'll start with the fact that it was extremely global. So we saw there literally was a point at which not a single country in the world had inflation 2% or below. So it was everywhere. So you have to look to common factors. And I would say that the pandemic and the closing of the global economy and then the reopening of it, in all cases with some support, that's a big part of the story. Clearly, though, there's a role in that for fiscal policy. There's a role in that for monetary policy. And I like to think all of those factors were involved. And but when it happens everywhere in the world, you can't look to one thing. You got to look to something, a common factor, and I think that common factor is what happened around the pandemic.
Sure, good. And build on that idea. I hated Monday morning quarterback, but if you had to do it over again, you had this opportunity. As you know, the rates stayed pretty flat in 2021 as inflation creeped up. What would you do differently today if you had the opportunity to look back and make some changes?
I have perfect hindsight in this.
Yes, sir, if you had it, yeah.
Sure. So I would have raised rates a little earlier. I honestly don't believe it would have made much difference to the outcomes, but we would have looked a lot smarter. But that's something I would have done. The other thing is, ultimately, we did get all the way back to 2% inflation just about without having a big increase in employment. So that was not at all expected. So I don't know how that would have affected my behavior, but somehow things really came out much better than everyone had anticipated, was that it would take, high unemployment to restore inflation, but it didn't.
And the other pressure point that I hear a lot of people talking about is this idea of the tariff issue. I've heard for months now that the sky is falling, but it seems at this point at least that the inflation rate is pretty steady. And how many months of steadiness do you need before you might look at an even larger rate cut from the 4.33 I think we have today?
Yeah, so you're right. Inflation, the non-tariff parts of inflation that we've been working on for 3-4 years are behaving really well. And that was our forecast, but it's good to see it coming true. I would say we expected that tariffs take a while to work their way through the distribution chain, several months. And I would say we would expect to see meaningful effects, kind of June, July, August. And if we don't, we'll be learning something. We have a highly adaptive, flexible economy, and it's certainly a possibility that the tariffs that we expect will come through in a much smaller level. We can't know that until we actually see it, but I think we'll be learning as we go. And if we see that, then that would lead us to want to cut earlier. The other thing that would lead us to want to cut earlier is if we actually did see some weakness in the labor market of a troubling nature. We don't see that. Those are the two things we'll be looking for.
And the last question I'd ask is, at that same time period where, as you put it, the global issue of inflation, I get that, but at the same time period, there's pretty radical increase in spending in 2021 by the federal government. What factor did that play in the inflation level?
Certainly a factor, I would say. As I mentioned, fiscal policy definitely played a role. I think if you take a step back from those things, what happened was demand came back so much stronger than we expected. You remember, if in late 21, early 22, you had the pandemic still going on, Omicron going, was it 21? Yeah, 21 into 22. And demand was just much stronger than people expected. And by the way, the supply side was much slower to recover. So that's the labor force, that's all of the snarled up supply chains. The supply side took a long time to recover, and demand was much stronger. That story created the high inflation. Behind that, fiscal policy played a role, the spending did, monetary policy played a role, and the pandemic.
But you would agree that the government spending did play a significant role in that as well?
Yeah, I would say that.
Okay,
Yeah.
thank you. Thank you, Mr. Chairman.
Gentleman yields back. The chair now recognizes the gentleman from Illinois, Mr. Foster, who is also ranking member of the Financial Institutions Subcommittee for 5 minutes.
Thank you, Mr. Chair. Following up actually on Rep. Gonzalez's line of questioning, so in addition to your dual mandate, do you believe that that preserving the U.S. dollar and the primacy of the U.S. dollar is part of your job description?
I think it's something, it's not formally part of our job, but yes, it's something that we care about, and we certainly wouldn't want to undermine that. But that's really, Treasury has the primary role around the dollar. That's been the case for some time now.
Yeah, I was just wondering how you deal with the sort of worldwide drop in investor confidence in dollar-denominated assets. Frankly, due to a president who kind of disregards conventional economic theory and whose answer to nearly every question seems to be, well, I haven't decided yet, or maybe I'll give you an answer in a couple weeks. Maybe I'll just comment, it must be challenging. Now, one of the things I've been very concerned about is, in terms of the job market, is artificial intelligence and the coming impact there. We're seeing predictions by the leaders of the leading AI firms that within 1 to 2 years, a majority of entry-level white-collar jobs will be gone. And there are products that are being released to market that propose to do pretty much exactly that, and I anticipate pretty high uptake of those things to essentially eliminate back office operations in small businesses, things like that, or intermediate-sized businesses. And we're already seeing layoffs in the big tech firms. Microsoft had a big round of layoffs where 40% were computer coders and maybe another 20% supervisors of computer coders. And so I was just wondering, what sort of analysis is the Federal Reserve doing about that job shock, and how is it going to affect your dual mandate when it lands, perhaps as early as the next year or two?
So I think economists everywhere are doing work analyzing the potential implications of AI for employment, and some of the very things that you mentioned. And we're certainly both consumers and producers of that kind of research. And don't think anybody, I certainly can't make any positive statements with great confidence about what will happen, but there's certainly a possibility that, at least at the beginning, AI will replace a lot of jobs rather than just augmenting people's labor. Over a long run, the history shows that generally new technology raises productivity and creates new jobs over time, but it can be disruptive in the very short term. And AI, anyone who's been exposed to AI has to be kind of stunned with what it's capable of. And you think, if you think, oh, this is just the beginning, they say that 2 years from now, the things you're looking at will be left behind by the continued development. So I think it is certainly everything you would want in a transformational technology, and I think that unknowable, but certainly to be important effects on the labor market. And I hear the same things you mentioned from CEOs, that they can see a way to significant reductions in employment, but I don't think we know that.
Yeah, but the question is, are you developing a playbook for this shock? Part of your job is to look at tail risk, and this is probably not even a real tail risk at this point. A lot of the CEOs think it's more probable than not. You're seeing law firms just not hire the same number of junior associates just across the economy. Are you actually developing a playbook in case the shock is real, and what you may or may not be able to do with monetary or
our
policies?
The playbook is really in your hands and in the private sector's hands. We will be trying to maximize employment, and that will be what we do. And we'll try, at the same time, we maintain price stability.
Yeah.
So we don't have the tools to. You're talking about transitioning people into new jobs and new lives, and
before AI wipes out those new jobs you're retraining them for. Yeah, it's okay. Well, but think about it. I urge you to think about it and what you will do if that job shock hit. So last week, Fed put out a request for information on ways to mitigate check and payment fraud. Despite a decline in the use of checks, check fraud is really very prevalent. And I was happy to join Chair Hill in sending you a letter and other banking regulators, as well as FinCEN, urging action. Can you summarize what you have in mind doing in response to that letter, or what you've learned the outreach that resulted from it?
So this is on the check fraud thing. Yep. I just know we just started a request for information, and I think we're starting a process of gathering a bunch of information, and really focusing on that issue.
Okay, and if you could say what you're actually going to do in response to that.
Gentleman's time has expired.
Thanks.
Thank you. Yield back.
Gentleman yields back. I now recognize myself for 5 minutes. Chair Powell, we've discussed this several times before, but the issue remains, so I continue to raise it. I sent you a letter several months ago urging you to seek public comment and permanently revisit the SLR and ESLR, particularly given the constraints current calculations places on market participants' ability to intermediate in the Treasury market. I'm glad to see that you're meeting tomorrow to discuss the issue. And I know you've discussed this with Mr. Flood, but I want to clarify a couple of things. The last time you testified before the committee, you said you were concerned about the levels of liquidity in the Treasury market, and that one obvious thing to do would be to reduce how binding the SLR on intermediate capacity. Are you considering changes in the SLR and ESLR, and will you consider exempting treasuries and reserves from the SLR and ESLR?
So I do think we've effectively raised the capital tax on all kinds of intermediation activities, and that certainly includes Treasury market activities. So I've long favored leverage ratio reform, and so we're putting out a document for comment, which will seek comments on one particular proposal and alternatives to that proposal, as I mentioned earlier.
Which I think answers my next question, which will you look at changes at the leverage ratios that constrain a bank's ability to participate?
Yes, that's the idea.
In your view, would allowing netting mechanisms for derivatives on treasuries encourage participation in the market? And would you consider looking at that with your prudential counterparts?
This is for derivatives?
Mm-hmm.
My first phone call on that would be to Vice Chair Bowman to ask her what she's planning, but I'm certainly open to that conversation.
Absolutely. Let's discuss the framework review. You've said that the review of the consensus statement is complete, but potential changes to communication strategies and tools may continue into the fall. When can we expect the framework review to be complete, and will you provide opportunities to receive feedback from members, industry, and the public on any changes the board is considering?
So the framework review, there are two parts of it. There's the consensus statement, which contains our monetary policy framework, and then there's communications. On the first, the framework, we've had the meetings that we needed to have to talk about the employment mandate and the price stability mandate and how we might change the framework. Now comes the discussion between participants on the committee, all 19 of us, about exactly what language to use in the new framework. And we're just entering that phase between these two meetings and at the July meeting, and hopefully we will be able to announce something near the end of the summer. And I expect that will be, and by the way, we've talked about, we've laid this out a little bit in the minutes as we go.
One last question. The MPR notes that the FOMC's policy deviates from the first difference policy rule. Will you provide a justification for why the FOMC decided against that path?
Against the first difference rule?
Mm-hmm.
Well, as you probably know, There are 5 rules that we talk about there, and the first difference rule is the one that calls for a price hike. The other 4 say that we're in the right place. So the Taylor rules generally are very supportive for where we are. It so happens right now. First difference rule is a very interesting concept, which we can talk about online, which has a lot of appeal, but it can be a little bit volatile too. And right now it's calling for a rate hike. The other 4 are calling for us to hold our policy where it is.
The irony. Thank you, Mr. Chairman. I yield back the balance of my time, and I turn to the gentleman from Oregon, Mr. Bynum, for 5 minutes. Ms. Bynum for 5 minutes.
All right, thank you, Mr. Chair. I want to start off with just kind of a foundational belief I have. This big, beautiful bill is trash, and it's actually increasing our costs. But thank you for being here today. I was just back home and saw firsthand that businesses across the country, across my state, are worried about inflation and rising costs. And particularly for our state where we make chips, we import, export agriculture, and we have apparel. So just want to level set there. My Republican colleagues have actually been focused today on asking you to lower interest rates, but they're seeming to ignore the market chaos that the president has caused. So my first question is, it's my understanding that one of the key responsibilities of the chair of the Federal Reserve is to stabilize prices and fight inflation. Is that right?
Yes.
By my count, the President Trump, has changed or announced a new tariff or a delay of previously announced tariffs 19 times. And so has the president's ever-changing tariff made it easier or harder to stabilize prices and fight inflation?
So I by practice, never comment on things the president does or says.
Has the administration's policies on tariffs?
Or the administration.
Has the change in policy on tariffs made it easier or?
There's DIY, and there's doing it yourself. It's the difference between being creative and being a creator.
So it's not up to us to judge these changes. These are things that elected politicians get elected and do, and it's just not our job. Our job is to provide stable prices and maximum employment to the public, and that's what we do. So we do expect there will be a set of price increases from some of the price increases from tariffs will flow through to the consumer. We don't know whether that will be persistent or how large it will be, and so right now we're kind of in watch and wait mood until we have a better sense.
Is your sense that back to school will be affected, the holiday season would be affected? You mentioned it a little bit earlier on how you didn't say the exact time frame, but you thought maybe a few months we would start to see changes from
I think
tariff
we're going to be learning as we see. We'll get before the July meeting, we'll get a inflation report well before that. And, we're going to be looking to see, we expect to start to see meaningful increases through the goods channel. And if we don't see that, then that'll be telling us something. We'll be learning from that. And by the way, we'll also be looking at the labor market. If it weakens unexpectedly, we'll be looking at that too. We will continue to adapt to the evolving situation as we have been doing.
Thank you. So what market conditions would make it so that the Federal Reserve would be able to lower interest rates, which would also lower costs?
So as I just mentioned, I would say if we were to see that inflation is not coming through as our forecast and other public forecasts have suggested, that would push us in the direction of being able to cut sooner. Also, if the labor market were to weaken, that would push us in the direction of being able to cut sooner. I think if the opposite happens, if the labor market remains strong and we do see higher inflation, I think we will still get around to cutting, but it would be later rather than sooner.
What do you think American families are expecting from the Federal Reserve?
Stable prices and maximum employment. That's what we want to deliver. And, we want people to feel so confident of price stability that they never think about inflation. That's where we were for a very long time. And we've made a lot of progress back to that place, but we're not quite there yet. And we're going to finish that job.
Is there a plan that the administration has presented on how it plans to lower costs as opposed to providing tax breaks for billionaires?
Again, it's really not up to me to discuss the administration's priorities or policies.
I'm going to quickly switch gears here. It seems to me like you're under a lot of pressure from the president to address the national debt. True, false?
Sorry?
Are you under pressure from the president to address the national debt?
So our role is maximum employment and price stability. Fiscal policy is the responsibility of Congress, and so it's not really within our ambit.
I think that despite all of the talk about national debt, this big, beautiful trash bill, continuing to do that will actually raise the national debt. So thank you for answering the questions today and continuing to work to lower costs.
The lady's time has expired.
Thank you.
Thank you. The chair now recognizes the gentleman from Kentucky, Mr. Barr, who is chairman of the subcommittee on financial institutions for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for the generosity of your time. We're at the witching hour, but appreciate your endurance. And with respect to my friends, the gentlelady's line of questioning, would a recession that would potentially result from a massive tax increase, a $4 trillion tax increase, would a recession help the debt and deficit picture?
No. Tax receipts would go down and all that.
Yeah, so I think this sky is falling scenario about the one big beautiful bill, we have to put into context, and I'm not asking you, Chairman Powell, to comment on this, but this is my editorial response to my colleague. A massive $4.5 trillion tax increase that would put us into a recession is not a recipe for fiscal discipline. Chairman Powell, let me switch gears to tariffs. Governor Waller argued in a speech earlier this month that tariffs might result in just a one-time price increase as opposed to increasing long-term inflation expectations, especially since this Congress has not pumped massive spending into the economy as Democrats did under President Biden. On this issue of a one-time price increase versus inflation expectations, do you generally agree with Governor Waller's analysis?
So I do agree that basically, if things are a one-time increase, then you don't respond to them. That's the whole idea, is there's a shock to prices. It could be an oil shock, could be a tariff shock. Generally speaking, you don't respond if you are highly confident that it will just be a one-time shock. I think the current situation, though, is a complicated one, and I think a number of my colleagues and I feel like it's a decision we need to take with some care. And the reason is because, we're not at price stability. In 2018 and 19, when the president's tariffs were put into place, not only did we not raise rates, we cut rates 3 times that year because the tariffs were so much smaller. These tariffs are many times larger, and they do raise kind of more concern. In 2019, we hadn't had high inflation in 30 years. Now we're only a few years reduced away from high inflation. So I think we think that they may well prove to be a one-time thing, but in the meantime, it's a decision we want to approach with some care.
I think we've made a lot of progress towards getting closer to that 2% goal. Does the Fed take into account the disinflationary fiscal policies like supply-side tax cuts, deregulation, and more energy production that could be a counterweight to whatever one-time price increase that might materialize as a result of tariffs?
So we look at aggregate inflation, not any particular kind, and I'm very gratified at the performance of services inflation, which has come down now. That was the very sticky inflation. So I think overall the inflation picture is actually pretty positive.
Chairman Powell, we're looking forward to this rulemaking later this week addressing Treasury market liquidity. Can you talk about how banks are constrained from holding U.S. Treasuries and other low-risk assets on their balance sheet as a result of these restrictive leverage ratios?
Yes, when banks are bound by the leverage ratio, when that's the binding capital constraint, then that's going to make low risk, low return assets, something you don't want to hold. And so lots of fairly low risk intermediation, including Treasury market intermediation, gets taxed to the point with capital requirements that you you just see less of it. So I've always thought that it would be better if we had a leverage ratio that was a backstop rather than the binding thing, and that's what this proposal is going to do.
Well, let me preemptively thank you and Vice Chair of Supervision Bowman for working on SLR reform to accommodate more bank holdings of treasuries to stabilize our treasury markets. Finally, I'm pleased to see that the Fed joined its interagency counterparts and announced that you no longer plan to consider reputational risk in your examination process. Senator Scott and I introduced the FIRM Act to stop the weaponization of the supervision process, to stop the targeting of politically unfashionable groups. Our bill requires regulators to focus on the true risks as opposed to political factors. What was the Federal Reserve's thought process in implementing this common sense reform?
That it's common sense. And, I think this is an area where we learned over the last couple of years that there really was a problem here. The reports were louder and louder and more troubling. So we just thought, let's take this off the table. It may have been unintentional on the part of banks that there was so much. It was just such a
Gentleman's time has expired.
Fraught issue that banks turned away people which they didn't intend to discriminate. That's what the banks.
Thank you for helping to
announce
depoliticize the banking
to the
system.
membership,
I
we
yield
will
back.
recognize Mr. Torres and Mr. Loudermilk, then adjourn for our 1 p.m. agreed to hard stop time. And with that, the gentleman from New York, Mr. Torres, is recognized for 5 minutes.
Thank you. Chair Powell, you spoke about elevated uncertainty and declining sentiment in the U.S. economy. Do you believe, as I do, that the economy would be in a better position but for the elevated uncertainty and declining sentiment created by the Trump tariffs?
I don't want to be criticizing policies. I will say uncertainty has.
Is it fair that it's fair to say that the policy created uncertainty?
It's fair to say uncertainty was very elevated, but it's also fair to say that uncertainty has actually come down since the peak, if you will, in April. I think there's a different feeling out there now than there was 2 months ago, and it's more constructive feeling on the part of businesses, which you must be feeling too.
But it's higher than it otherwise would be in the absence of the Liberation Day tariffs. To what extent was the elevated uncertainty a factor in keeping the Fed from cutting interest rates?
So I think that's part of it. The truth is, we were cutting rates, and we paused in January and haven't cut rates since. And really, the reason is that we, like other forecasters, do expect a fairly substantial wave of price increases to come through to the consumer and to measured inflation. We've always said the timing, amount, and persistence of all that is highly uncertain. I think we hadn't expected to see it until now. We now begin to think it is time for us to be seeing that. And if we don't see it, that will matter. If we do see it, that will matter. So we've just taken a cautious approach to not moving our policy rate until we have a little more confidence about the size and likely effects of that.
Chair Powell, following the so-called Liberation Day tariffs in early April, we saw something the U.S. economy had not seen in decades. A flight not to the U.S. dollar as a safe haven, but away from it. And since President Trump's inauguration, the U.S. dollar index has fallen by nearly 10%, marking the worst first-half performance for the dollar since 1986. At the same time, Japan, America's largest sovereign creditor, just saw the worst 20-year Japanese government bond auction since the 1980s, raising fears that it could reduce its holdings of U.S. treasuries. Given these developments, do you believe, as I do, that the U.S. may be transitioning from a period of dollar dominance to a period of dollar decline?
Well, let me say, the Fed does not have responsibility for the dollar. That's really the Treasury. But
I'm asking for your analysis.
I wouldn't make that statement. No, I think things have been volatile. The markets are digesting things, and I think the Treasury market's been fine by many measures. The dollar is still.
You feel the safe haven status of the dollars is as strong as it's ever been?
I think the dollar is still the number one safe haven currency, and I don't think it's. I would say these narratives of decline are premature and a bit overdone.
I want to ask about the debt. The big, beautiful bill would have ugly consequences for our nation's finances, adding more than $2 trillion to the debt if the provisions are temporary and far more if made permanent. We've accumulated World War II levels of debt not during a world war, but during peacetime. Interest payments on the debt have become the largest item in the federal budget after Social Security, surpassing Medicaid, Medicare, and military defense. To what extent is the U.S. at risk of entering a debt spiral in which rising interest costs lead to ever larger deficits, which in turn lead to ever larger interest costs?
Yeah, I think that the U.S. federal budget is on an unsustainable path. The debt is not at an unsustainable level right now, but the path is not sustainable. And I think the sooner we deal with that, and by we, I mean you, the better.
The Trump administration has championed the unitary executive theory, the notion that the president has absolute power over all entities that wield executive power. That theory, if taken to an extreme, would all but abolish the independence of the Federal Reserve. If monetary policy became nothing more than an expression of presidential will and whims, what havoc would that wreak on the U.S. economy?
I think that independent central banks have proven over time to be a valuable and critical institutional practice. And I think that is because basically advanced economy democracies around the world have given their central banks a degree of operational independence. They assign them goals. You go do this and you stick to those things, but we'll let you, you may choose the means of achieving those goals. It's called instrument independence, but not goal independence. And I think it's a very
Gentleman's time has expired.
Very important practice.
Gentleman's time has expired. Chair now recognizes our last member of the day, the gentleman from Georgia, Mr. Loudermilk, for 5 minutes.
Well, thank you, Mr. Chairman. Chairman Powell, it's good to see you again. And I'm going to be brief, so maybe we can get out of here right at time. As some of my colleagues know, I chair the bipartisan Payments and FinTech Caucus, along with a fellow Georgian on this committee, Representative Davis Scott. And in the past, you and I have talked about payment-related issues like FedNow, but today, I'd like to ask you about the failure of Synapse Financial Technologies, a third-party service provider that connects banks with non-bank fintechs, and what it means for the bank and the non-bank ecosystem. Last year, a dispute between Synapse Financial Technologies and Evolve Bank and Trust revealed a shortfall in customer savings deposits of $65 to $95 million. There are still thousands of individuals who are not able to access their funds, including some of my constituents. So the question is, could you provide an update on what the Federal Reserve is doing to ensure that customers regain access to their funds? And is there anything that the Federal Reserve is considering to help prevent situations such as this going forward?
So I don't have a lot of specifics for you on that. I am assured that we're still very much doing everything we can to try to get people their money back and to avoid similar occurrences.
Okay. Well, I said I was going to be brief, and that was a brief answer. So with that, I yield back, Mr. Chair.
Gentleman yields back. The chair would like to thank Chairman Powell for his testimony today. And without objection, all members will have 5 legislative days to submit additional written questions for the witness to the chair. The questions will be forwarded to the witness for his response. And Chair Powell, please respond no later than January 29, 2025. This hearing is adjourned.
Its inception of November of 2020 has been Amphenol, another all-time high today. If it wasn't rules-based, Scott, I probably would have sold it.
Okay, just to underscore it, can't say it enough. We're less than 1% away on the S&P from a new all-time high. I'll see you in a couple hours on closing bell. The exchange begins now.
Thank you very much, Scott. The Middle East is on edge, and Fed Chair Powell is in the hot seat today. Hi, everyone. I'm Kelly Evans, and welcome to The Exchange. Stocks are higher on hopes this ceasefire will hold. As you just heard Scott reiterate, the S&P is 1% from its all-time highs, believe it or not. Big tech breaking out. The Nasdaq's up 1.5% today. And in fact, the Nasdaq 100 is at an all-time high, maybe first to reclaim that level. Amazon and Nvidia are the top performers there. Flip side is oil absolutely collapsing the last 2 days, down 6% today, 13% lower now in just the past 2 sessions. We're back to around $64 a barrel. Interestingly enough, gold is also back to a 2-week low as it kind of a little bit of that flight to safety move becomes unwound, and we're down about 1.8%. So not a huge deal, but still something to watch as a risk barometer. And it all comes as Fed Chair Powell is testifying on the Hill, and President Trump once again ramping up pressure on the Fed chair to start cutting rates, saying they should be 3 points lower. Powell not in any rush to get there, though. Let's start there and with CNBC's senior economics reporter, Steve Leisman. Fed Chair Steve, very much now and at the meeting that they just had, sounding, I don't want to quite say hawkish, but, hawkish.
I think that's right. And by the way, he would not take the bait when asked about the president's criticism. He would not respond at all. But Fed Chair Jay Powell, just finishing day one of 2 days of testimony before Congress, sticking very much to his view that tariff inflation is likely coming and the Fed should wait to see how it affects the broader economy before cutting rates. But he did suggest that policy could adapt if Powell said he expects tariff inflation to show up over the summer, but noted that most officials still have 2 rate cuts built in, so they get there eventually. That's how the Fed futures markets continues to trade. July, not much probability. It is elevated from where it was, but it's still just 19%. September, December, pretty secure now, 86 and 84%, well, at least a lot of confidence in there. 2 Fed governors, obviously Waller and Bowman, said they could see a rate cut in July, but several Fed officials, including John Williams from the New York Fed, joining Powell today and in previous days in saying the Fed should not be in a hurry to cut rates until it understands the impact of tariffs on inflation. So, Kelly, that's where we stand.
Right. So anything else, Steve, that you would add or that he said in regards to the geopolitical events of the week? Or, I mean, oil now sort of taking itself back out of the equation, at least for the moment.
Oil was barely an issue. Obviously, there's this, how do you say this, undercurrent among Republican questioners that are trying to say, you were kind to Biden and you're being mean to Trump. I guess that was one undercurrent that was out there, though not explicitly said. But of course, Powell points out that the Fed had rates of 5.33 during a lot of Biden's tenure, and the issue being whether or not the Fed should have responded more quickly to the bill to the big spending bills of the Biden administration, rather than being so sensitive to the possibility of tariffs. But I don't hear, Kelly, the Fed chair saying, I'm not going to cut. What he's saying is, I want to make sure that we don't have a broader inflation problem before I do.
Right. And I guess, did he give any sense of how many months of data, how many months more he would need? Did he say, like, OK, already the data so far has been contained, I want to make sure June and July? Or is this just an open-ended, like, maybe it's going to be next month that inflation shows up?
I don't think it's open-ended. I think June and July are probably, and by the way, it's fascinating you asked that question, because it really does show that there is probably, if my answer is correct, if I end up being right about this, really modest differences. If people want to, I think, a food fight at the Fed, well, maybe there is. But really it's between June and July, waiting on those inflation reports and cutting in September, or cutting in July. So that's really the big gap between them. Is it a 2-month gap? Will the fate of the nation, the fate of the largest economy in the world, rest on whether the Fed cuts a quarter point 2 months later? I don't think so.
All right. Steve, for now, thanks. Appreciate it very much. Our Steve Leisman there.
Pleasure.
And my next guest also thinks that rates should stay where they are for now. Let's bring in Binky Chadha, the Chief Global Strategist and Head of Asset Allocation at Deutsche Bank. I don't think the president will come after you for expressing this view, Binky. Just because, the Fed chair says it's one thing, you're allowed to have your own opinion. But why do you think that we shouldn't have any further movement here? I mean, the inflation reports have been pretty good.
So I think it's a day where, we've heard the arguments on both sides. What I would share is basically a cautionary tale from the early 1970s that is due entirely to my colleague, our rate strategist, Francis Yared. So you will recall in 1973, we had a massive oil shock and shortages. Inflation picked up, and the Fed hiked. And what long rates did is actually go sideways to slightly down. Then we got a recession, and the Fed cut, which is what everybody is sort of arguing for or clamoring for today. And what happened to the term premium and the long end is went up, and it kept going up. So when the Fed did not cut or actually hiked, the 10-year went down.
Right.
And when they started to cut, it is really like the inflation shock was being accommodated, and the term premium went up
by the
more
way,
than a percentage
would you
point
argue
of
that's
10-year yield.
is that what we saw in the fall when they cut and the long end went up?
Exactly. So, it sort of all hinges currently on how you think of basically the shocks that we are getting, be they tariffs, oil prices. Yes, we've just done a round trip. But if you think that this is a negative supply shock from the tariffs and the tariffs not resolved, and that's really the next catalyst right around the corner on April the 9th in terms of what happens, if it's a negative supply shock, I don't really think that it makes a lot of sense, and it may create a lot of basically relatively perverse dynamics.
You want to know what I would like to do as Fed chair? And this may be unorthodox and frowned upon, but it would be a good, interesting experiment if you come out 1 week and you kind of, jawbone that you're going to cut, for instance, and you just watch the market reaction. And then you come out, and so is the long end going up or not, right? And then you come out and you say, no, I think we're going to be tighter. And then you watch the reaction.
I mean, conceptually, I agree. It's just that the Fed can't afford to do experiments in the market.
But maybe it'd be safer to do an experiment to kind of at least suss it out instead of just pretending like they know what's best.
My cautionary tale was an experiment. I mean, we already lived through that, so it can very easily happen. And so I think initial conditions matter. The fact that we've had this inflation experience over the last few years, the fact that inflation is still above target, yes, there is going to be a divide. So our economists have a great piece from yesterday, Matt Luzetti and company, and making the simple point that everybody talks about uncertainty. Well, if you look in the dot plot and the various other things that go along with it, the uncertainty on growth, for example, unemployment, it's actually not very large. It's 30 basis points between the highs and the lows. So there is uncertainty, absolutely clear, but it's not unusual by historical standards. What is unusual is the divide and relatively bimodal view on what monetary policy should do. So there's the data issue and what's happening in the economy, but the uncertainty about that is not unprecedented relative to history. It's well within the ranges. And the question really is what monetary policy should do. And again, I would go back to, is this a demand shock? Is this a supply shock? The data is not really telling us anything yet, and it's a bit early. So the case for waiting to find out and staying where we are.
Again, test the market. See, sometimes the market knows the demand or supply. We do have a 2-year note that just went up for auction. Speaking of rates, let's bring in Rick Santelli quickly with those results, Rick. And what are they telling us?
Well, I'm calling it a C-, a Charlie minus. There was nothing very special about this auction. The yield, 3.786, and maybe that was the most special part of all, because that's the lowest yield at a Dutch auction by the government on a primary auction since September. So yields moving down, and they're moving down rather dramatically, actually. What stuck in my mind here was dealers took a little bit extra. The combined indirect and directs was a little bit light. The bid cover was a little bit light, really, and it priced okay. The when issued market and the yield here were basically on top of each other, but there was nothing that really stood out as a positive. Of course, we have 5s and 7s yet to go. My signals on my charts, which circle my office at home, certainly look like yields are going to keep going down. Yesterday's close, in my opinion, was a close that brings in more buying. And boy, market seems to be cooperating. And the stock market obviously is going to like that. The dollar, not so much. And it certainly does seem, Kelly, that the market seemed to understand the issue of tariffs better than the experts. Back to you.
All right, Rick, thank you very much. Thank you. Just a final comment on this. I want to go back to your view on the market, but the president in his post earlier on said, we should be 2 to 3 points lower on the Fed funds rate. He said it would save the U.S. $800 billion a year plus. Now, of course, again, we're conflating long end with short end here, but what would be if you just took the president's wishes at face value and you're his economic team and you said, well, what's the quickest way to get the long end down 2 or 3 points? Is there an answer to that other than sharp recession, or what do you think?
A big fiscal contraction and a serious medium-term plan, that would get the long end down. But I think short of that, it's not so easy. So short rates and long rates, can move in opposite directions. As you pointed out, we saw that last year. And so that can happen again. So,
but you think really if the president himself, if this Congress, they're working on this bill right now, if they really had fiscal consolidation or contraction there, that could bring rates down 2 to 3 points like he's wishing?
Yes. I think 2 or 3 points is a bit large. I think that's arithmetic that comes out of the post-global financial crisis period of unusual period of monetary policy. I think the 10-year is kind of, where it should be if you start with the simplest old school way of thinking about the rates world. We have basically real growth of 2.5% in terms of GDP. We got an inflation target of 2%. So, we should be at 4.5%. That's kind of where we are. And yes, we're moving around by 10 basis points one way or the other, but we're right where we what the oldest school way of looking at rates would basically say where we are where we should be.
And by the way, that much fiscal consolidation probably would be recessionary, at least in the short term.
Absolutely.
So it kind of quickly, amid all of that, 65.50, is that still your year-end price target on the S&P? And it's been amazing how resilient this market is.
Yes, and I would say, in terms of equities and the S&P 500, I'd say the key thing to keep in mind is that despite where the market is, equity positioning is still underweight. So there's plenty, basically, of room for positioning to rise. If the economy and earnings are fine, the buybacks are going to continue. We've penciled in $1.1 trillion for this year. And the inflows, it's summertime. They tend to be a little lower then.
Yeah, so we'll give us some more ammo maybe into the fall and into year-end. Binky, really appreciate you coming on today. Thanks for your time. Binky Chadha with Deutsche Bank. Let's get now to the latest developments out of the Middle East. The president expressing his deep discontent with Israel after the country appeared to violate the ceasefire agreement put into place last night. Here's a listen.
I'm not happy with Israel. When I say, okay, now you have 12 hours, you don't go out in the first hour and just drop everything you have on them. So I'm not happy with them. I'm not happy with Iran either. But I'm really unhappy if Israel's going out this morning because of one rocket that didn't land, that was shot, perhaps by mistake, that didn't land. I'm not happy about that.
The president following up on those comments in a Truth Social post later this morning, saying Israel is not going to attack Iran. All planes will turn around and head home. Nobody will be hurt. The ceasefire is in effect. And it all comes as Trump heads to the Netherlands for his first full day at the 2025 NATO summit, where our next guest is also in attendance and says this could be a huge victory lap for the president's Middle East policies. Let's bring in Fred Kemp. He's the CEO of the Atlantic Council and a CNBC contributor. Fred, welcome. Listen, the investor base kind of just wants to hear about defense spending, but obviously this is a huge moment for the president to arrive and hope that perhaps this conflict between Israel and Iran is behind us. We'll try to unmute Fred's mic so we can actually hear what he's saying there. But again, President Trump heading to the NATO summit today, where all countries are encouraged to spend about 3.5% on core defense and another 1.5% or so on defense-related spending, and that's got defense stocks all excited. So, Fred, we can pick up where you were starting a moment ago with the significance of his arrival there today and this hope that the Iran-Israel conflict is now behind us.
Kelly, first of all, I'm really sorry. Usually I just leave myself muted when I'm on the office calls. Look, Iran yesterday really showed its hand. And what it showed was through its proportionate response, through its really performative response, signaling to Qatar in advance what it was going to do, and then striking in a way that was not going to kill any Americans. It really said we want an off-ramp and we don't want escalation because this is really about regime survival. And if the regime needs to survive to another day, it doesn't want to escalate, isn't going to escalate. So I think these twos and fro's on the ceasefire, is Trump upset? Is Trump not upset with Israel or Iran? Look, war is unpredictable. You can't know for sure what's going to happen the next day. But for the moment, I think the Iranian leadership is showing that it really doesn't have the stomach to escalate with Iran or with Israel or to escalate with the United States. And that gets to the victory lap here. People you're talking to already in The Hague who have arrived, they're in awe about what the U.S. pulled off. A 30-plus hour round trip from the middle of America with B-2s dropping 30,000-pound bombs. showing capabilities that most NATO allies can only dream of having. And he'll come here and he'll probably get what he wants. Spain seems to still be a holdout, but the Secretary General seems to have told Trump he's going to get his 5%, 3.5% core defense and 1.5% plus for related defense matters. And so that would be a very good week for the President of the United States.
You know, a lot of people here are saying it's the end of the taco trade, the Trump always chickens out trade. But let's not forget, that was really a tariff comment more than anything. It was basically the president ratchets up his tariff threat or, what he appears to be imposing and then kind of backs down and without necessarily securing it. I don't think that was ever really meant in the national security front. Nevertheless, what do you think the implications are, whether they're implications for what may happen with Russia and Ukraine next or on the tariff front?
Well, look, there's been some taco to the United States over the last years with Iran and with Russia, and so I think in terms of the security front, what Trump has shown with Iran is a willingness to reimpose deterrence on the Middle East and show that the U.S. means business. And if you don't come through, we've given you 60 days to negotiate. On day 61 was when the Israelis started their strikes and everything else followed with the U.S. I think what people here would like is a little bit more impatience with Vladimir Putin and the Russian leader. With Russia, Trump's just shown much more patience for him dithering with the negotiations. As Trump himself has said, he's tapping me with the negotiations. And they'd like to see a little bit more pressure on Russia, certainly not bombing, certainly not B-2s. But in terms of ratcheting up sanctions, there's a Senate bill sitting there with 82 co-sponsors. If Trump gives it the green light, they'll probably go ahead with that. And he could give clearer signs about continued weapons deliveries for Ukraine as well. I don't think we'll get that today and tomorrow, but that's really the kind of sign, once he's reinforced deterrence in the Middle East, perhaps we could do a little bit more to put pressure on Putin here as well.
Although his latest comments basically suggested he's going to let them fight it out for now, Russia and Ukraine. He made an analogy to teenagers or to kids fighting, really, and saying sometimes you have to let it go for a bit. So he seems trying to figure out what the right entry point is to then kind of impose those next levels. And, we asked this, of course, for what it would mean for the oil market. If the Iranian barrels are coming back, maybe that gives us more space to crack down on the Russian front. I don't know.
Yeah, so on the plane talking to reporters, I think what will be troubling to NATO allies is he was talking about the definition of Article 5, which is an attack on one is attack on all, and whether the U.S. would be obligated to respond. And I think the allies here would like to see firmness there. His ambassador, Matt Whitaker, was very strong talking on the record today in The Hague, saying that the U.S. is here to stay. Now, the U.S. is here to stay, meaning with NATO in Europe, but it wants a more equal partner. It wants a partner in Europe that's going to carry its weight in European defense. So I think that's the trade-off.
Yeah.
The U.S. is here to stay. We'll continue to do things, but Europeans, after many years since Eisenhower, really, American presidents have been calling for Europeans to spend more on defense. And if Trump really delivers that tomorrow, and all signs are that he will, that will be a historic summit.
Quickly, Fred, before we go, the president also made comments sort of saying, I forget how he phrased it exactly, Iranian barrels are coming back. You're welcome to the Chinese, kind of you're welcome to the Iranians. So tacitly acknowledging this kind of back channel trade that's been going on for years now, but also suggesting that helping the Chinese secure those barrels he views as a positive outcome that they should be grateful for.
Yeah, this is a very unconventional president. We're just going to have to get used to that. I mean, one of the things that we haven't talked about yet is that on Truth Social, he shared Secretary General Mark Rutte's personal note to him, praising him for what he'd done on Iran, sharing with him that he's going to have success, a very big success in The Hague. This is just a different way of doing geopolitics. It's geopolitics as reality TV and reality social networking.
Yeah. Do you think there's any kind of fallout or implication, though, for the Chinese from all this?
Look, the Chinese, the Chinese and the Russians both put a lot of stock into the Iranian relationship. and both of them have reason to be disappointed. The Russians rely on Iranian drones. The Chinese rely on Iranian oil and energy deliveries. I think the president wants even markets on energy. He wants low prices. He doesn't want high prices. And so I think the ramification for the Chinese, it's really interesting watching the results on this. It's been relatively muted. And I think China is going to take this one on the chin. They have allies in Saudi Arabia and the United Arab Emirates. They're not going to want to do anything to upset that situation.
Yeah.
If Iran shuts down the Straits of Hormuz, who's it going to hurt more than anyone else? It's going to hurt China more than anyone else. So China actually could be a relatively reasonable player in this whole tense situation.
Helping reach, some prevailing peace, I guess we could call it. All right, Fred, thank you. Appreciate you making the time as NATO gets underway. Fred Kemp with the Atlantic Council. Coming up, we'll have more on oil, with crude down 14% in 2 days and now negative since Israel's first airstrikes 12 days ago. Plus, the president arriving at that NATO summit in the Netherlands later this hour. Will the conflict in the Middle East overshadow the 2-day goals there? We'll have more on that ahead.
This is The Exchange on CNBC.